unemployment among the kids is near 20%.
That's the problem.
Yeah.
Let me ask you this. I'm intrigued. What do you make of the shadow diplomacy coming from Kissinger?
Oh,
what do you think about that?
I'm hugely biased on this. It's a completely unfair question.
Well, what's the bias?
The bias is this. They created history, and I've had the honor of standing in the hotel room in Shanghai where Henry Kissinger secretly slept the night before they went off to Beijing to create history with Nixon. I've actually sat in the hotel in Beijing in the recreation the Chinese government has of the red leather seats where they met and all that. That's ancient history. And if I'm the Biden administration, I'm really wondering about the front running of this, of somebody always controversial, but Dr. Kissinger at 100 whatever, and the question of how does that relate into the administration? Did they know he was going to go?
Don't know.
Don't know.
AMH is going to join us in the next hour, but he seems to have access to high-level officials in that party that some people in this administration can't get a meeting with.
30 seconds under surveillance. What does Barbie do? I think 200
this weekend.
million. I think 200 million.
What did we get from Tom Cruise in Mission Impossible?
80,
was it 50, 60
it was like a
million in
little
the US
under,
over the weekend?
A little under the buzz. I think it sounds
You
like
think
legit
200?
buzz. I think like legit buzz.
All right.
All the kids want to go.
100 plus is the easy call.
The entire control room wants to go except Qantas. He's like, who's Barbie?
Oppenheimer, I can't get over how sold out that is. I want to go and watch that and just cannot.
Well,
the only seats available that I could find, Tom, front row. Have you ever sat like front row where your neck is,
it's like,
brutal? That's not a fun experience.
On inflation now, and this is the conversation of the day, on price change in America. He invented it, the analysis of it, I should say, with Bob Farrell years ago at Merrill Lynch. David Rosenberg joins us from Toronto. He is with Rosenberg Research. David, you slice and dice this. I want you to speak to Jerome Powell right now. Is the deflationary vector, is it in force, and will we stay with disinflation into 2024?
Well, I think the disinflation trend, Tom, will be the primary trend. We're going to have a bit of a bump, though, in the next month or two because the CRB has taken an 8% jump since the end of May for the reasons that you folks were talking about. And the question is, how the Fed's going to treat that and whether it's going to be temporary or permanent. This run-up we've had really across food prices in the commodity markets and also what's happened with oil coming off the bottom. If this was happening with a 4.5% to 5% unemployment rate and we had excess supply in the economy, not a problem. But at a time of full employment, this bounce we've had in commodity markets and in the context of the wage settlements we're seeing, I think has to be on the Fed's mind. So I would say that the primary trend is going to be towards disinflation into the next 12 months. But I would say that the next couple of months is going to challenge that view.
Are we beyond the pandemic? Are we doing traditional economics now, whether you believe in ISLM dynamics or you believe in factor dynamics, whatever, microeconomic foundations, whatever it is? Are we beyond pandemic analysis?
I don't think so, Tom. I think that we're still seeing a lot of the after effects. It's one of the reasons why, look, yesterday, nobody seemed to care too much that the Conference Board's leading economic indicator declined for the 15th month in a row. It's already gone down enough and far enough from the peak of December 2021 that the recession should have started. The inverted yield curve has been more than a year. It's very deep. The dispersion across all yield curves would be telling you that the recession should be starting. And we have this debate as to whether or not there's even going to be a recession. And so what's happened is that this was the Energizer Bunny. The gift that kept on giving were those stimulus checks from the Biden budget buster in March of 2021 and those excess savings, which historically Americans would spend half and save half. But we live in a much more narcissistic society today, right? I don't remember before this cycle, like you're asking me about is the COVID effect behind us, the worst of the COVID health issues behind us, but the COVID effects on the economy. I mean, we're developing new acronyms like YOLO, you only live once. So all the stimulus got spent, and that's what's basically clogged up the monetary channel from what the Fed has done to the real economy. And that might be ending right now, but it's one of the reasons why people calling for recession, like yours truly, have been frustrated, is because of the lagged impact of all that fiscal stimulus, which was
Right.
a product of the pandemic.
What's interesting about this, John, is you only live once. Rosenberg's going to see Barbie twice this weekend.
Supporting retail sites.
I'd bet against that.
David, I want you to dive here into my book of the summer, Blanchard and the R-star debate. Blanchard feels that over time we will return to some form of quiescent R-star. John Williams has staked out the high ground, saying we will return to R-star. Others go the other way. Are we going to be in a 2%-ish Fed range out 5 years, 10 years? Or does David Rosenberg have to set to a legitimate societal reflation?
Well, and I think you're referring to 2% funds rate in nominal terms as being that baseline. And Tom, what's very interesting is that, through all the pandemic and all the distortions around the pandemic, that the Fed never once has changed its long-run estimate of where the nominal neutral funds rate is. It's been stuck at 2.5%. The work that's been done, normally R-star refers to the real neutral rate, and let's assume that we get to that holy grail of 2% inflation. And then you have John Williams. By the way, our work has corroborated his work that there's a risk that R-star in real terms goes negative in the years ahead. And that's supported by what? Well, what did COVID not change, or the policies around COVID not change, is aging demographics. And aging demographics has been and remains a deadweight drag on the equilibrium.
John tells me every day. Continue, Mr. Rosenberg.
And the constraints of excessive debt is another consideration. And then we had something, this has been wonderful for the growth stocks in the tech sector. And it seems as though, NVIDIA back in May with that, truly, bombshell earnings report almost felt like Pfizer Monday, back in November of 2020. I'm not going to say this is bigger than the internet, but it's certainly bigger than 3D printing, and it's going to have monumental impacts on structural shifts in the labor market, labor-saving technology. That, again, is going to be, I think from a labor market perspective, a significant disinflationary force, just like the internet was, not on the same scale, but it doesn't have to be on the same scale to be a truly disinflationary force and an impact on R-star down the road.
David, I just want to squeeze in an extra question on that then. And this is really sort of like out there thinking down 10, 20 years, but how on earth are politicians going to deal with this, David, if we start to see that kind of job replacement from this kind of boom?
Well, it's going to be a big problem because with the aging demographics comes with that higher dependency rates, and that puts added pressure on fiscal finances at a time when governments around the world have been so profligate on the spending side. So this is going to be a very big fiscal problem. Some people say the only way out of this is we have to inflate. We have to inflate a way out of this debt problem. But the problem with inflation, and the reason why Jay Powell has been fighting inflation, and with cover from the White House, is that inflation is a tax on the poor and the elderly. So when people say, well, we have to solve the debt problem, with inflation, no, because it creates other social problems. Ultimately, we're going to have a revamping of the entire fiscal system, means testing on entitlements. And the bottom line is that this dirty 5-letter word called taxes are going to have to go up. And that's why I think that, when you're taking a look at why have bond yields not soared? Even with what's happened with foodstuffs and energy in the past few days, the Fed about to pin the funds rate at 5.25 to 5.5, the stock market booming. Why isn't the 10-year note have a 5 handle? Why are we at 380 on the 10-year note with all this? So the bond market's telling you something. It comes back to Tom's initial question. The bond market is telling you something about that disinflationary future. So I think that in terms of how governments deal with it, I think this era right now that we're seeing a fiscal rectitude is going to have to switch towards fiscal tightening down the road, because this is not sustainable. I'm looking at this thinking, if you told everybody what was happening with the stock market, fiscal deficits, everything that we're talking about right now, we have to ask the question, the biggest anomaly is not what the stock market's doing, guys. It's what the bond market is not doing.
Interesting.
What's that message?
We'll keep asking that question. David, this was fun, deeply thoughtful. Thank you, sir. David Rosenberg there of Rosenberg Research. Enjoy the movies this weekend. Barbie twice, really? Wow.
His son's, son wears a bow tie.
Didn't know that.
Yeah, one of the Rosenberg offspring.
Did you inspire that?
I believe so. I think I can take credit for that.
Your
David
official
Hayes.
guess, your official guess is 200 million for the box office this weekend.
No, I go 180. Seriously, I go 180.
Okay.
It's huge.
Interesting.
It's huge. It's an event. It's an event. I'm the only one in America not going.
It's been a while since it felt like this, since you had like a kind of movie weekend.
Yeah, I mean, Sasha in the movie's a problem. I mean, I like the Will Ferrell part, but Sasha's trouble. I mean,
Who's Sasha? I know nothing about this movie.
Sasha's
apart
in the
from
movie. She's trouble.
Margot Robbie, and that's it.
Sasha.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
The good thing for Netflix, of course, is they do have, a big production pipeline. If you told me the strike will last one more week, then it's a non-event. If you tell me the strike's going to go for 6 months, then it becomes an event for Netflix as well as everybody else.
That was Tim Nolan there, Macquarie analyst, on the latest with Netflix following the writer's strike over in Hollywood and beyond across this country. Netflix yesterday with one of its worst days of the year so far for the stock, off the back of better than expected subs, but something weird going on with revenue that we can touch on in just a moment. Going into a massive weekend for the theatre business. Tom, you mentioned some numbers around Barbie as that's released. Here are a range of estimates for you for the debut this weekend. 140 million to 175 for Barbie. Oppenheimer projected to near 50 to 70 million.
Lincoln Cinema, Lincoln 13. They're going to show
This
it
is an
like
IMAX.
8, 9, 10 times.
Right,
They're
sold
going to
out.
do Dolby Cinema 5 times as well. It's almost like it's back to, pre-pandemic. It's like a celebration almost.
Isn't it amazing? I've said this a few times. If you'd asked me back in a pandemic, would you go to the movie theatre again? I'd be like, no, thank you.
Yeah.
No, thank you. And here we are. It's great.
Well, you went and saw Tom Cruise.
Mission Impossible
Yeah,
last
yeah.
weekend, yeah.
Yeah,
That was a
okay.
disappointment at the box office in a big way.
Well, we're going to see. We're going to dive into it right now. And this is what Bloomberg Surveillance does. Within your Barbie and Oppenheimer uproar, we celebrate. I was told if I didn't wear a pink tie today, I couldn't come home. We speak to the experts, and truly the one that owns the high ground of analysis of Hollywood is Jessica Reef-Ehrlich. She is with us this morning, Senior Media Entertainment Analyst at B of A Securities. Jessica, you and I in our youth were hearkened by our parents back to 1939 and the sea change that was Gone with the Wind in Wizard of Oz. Is there a sea change going on with Barbenheimer?
With Oppenheimer,
With Oppenheimer and with Barbie? Is there a sea change going on?
this will be a big weekend, the first big weekend in a long time. I don't know if Barbie will do the numbers that you guys just threw out, but we're hearing something a little bit less, but we'll see. It will be a huge movie. It's going to be really big for Warner Brothers Discovery and of course for Mattel. and Oppenheimer is NBCU. So I think everyone's welcoming this. Of course, you can't talk about the movies without thinking about the strike and what will happen, as we move forward. But I guess everybody should just enjoy this weekend.
When in doubt, Hollywood copies success. If we deem a pink success here, how will Hollywood leverage this? How will Hollywood copy Mattel's brilliance?
This really was brilliant marketing. They've done such an incredible job between the two companies. Barbie is everywhere, and I'm sure will drive consumer products as well. So there's a lesson to be learned from all of the marketing and how well they've done. There's a huge backlog of films coming, which you would think would be positive. But again, you can't really talk about what's going on in movies or TV without thinking about the strike. If you don't have talent promoting the movies, I know that some of the studios are thinking about maybe moving schedules around.
Isn't that the biggest promotion, though, when the talent walks out on the promotion and goes to the picket line? Jessica, I wonder, how much of that is just virtue signaling, that they go out and they protest with people? Isn't that just promotion in itself?
Well, I mean, there are definitely headlines, so you may have a point with that.
Jessica, I want to talk about streaming and this strike. We caught up with an analyst just yesterday who said that if it goes on for another 6 months, that's a problem for Netflix and everybody. How much longer do you think this needs to go on before it starts to bite for the likes of Netflix?
Look, none of us know how long the strikes, plural, will go on. Impossible to say. It feels like everybody is far apart at the moment. But I would liken this maybe to COVID, when nobody could produce, and we still all watched. Everybody kind of, ran to streaming. There are global production. As far as I know, there's not going to be a global strike. Strikes, again, plural. So there's global production, and all of us have long lists of things that we, that want to see and haven't seen yet. So this is going to be positive for the streamers, and sadly, it's really bad for linear. It's bad for cable. It's bad for broadcast, and the talent gets paid more from linear than it does from streaming. So it's ironic, but it is.
Jessica, I just had a scary thought. You in Patagonia at Sun Valley. If you were at Sun Valley talking to the billionaires on the Hollywood roll-up, do you anticipate a lot of mergers, and specifically with Warner Brothers Discovery with 57% debt, I believe it is? What do they do within the merger frenzy to come?
I do think there will be a lot of M&A because there are many mid-sized players, and it's, scale. This is a global scaled business at this point. Whether it's Warner Brothers Discovery or not, we'll see. They do have a lot of debt, but they also have a lot of cash, and I think they'll pay down debt fairly aggressively this year and bring the leverage ratio down a lot. I think the bombshell, the recent bombshell was from Sun Valley, was from the Allen & Company conference with the Bob Iger CNBC interview, where he essentially said he will find a strategic partner for ESPN and, will somehow divest of the linear assets. What that means, that's more unknown, but it was so interesting. Finding a strategic partner for ESPN could be the first move that causes a ripple effect in the media system.
Yeah, but we've got to have profitability within streaming. Do you discern a legitimate, sustainable free cash flow out of whatever the streamer is, $7 a month, $8 a month? Is the profitability stream embedded in your Excel spreadsheets?
Yeah, no, look, unfortunately, what the strikes will do is give everybody a chance to reassess their content spend. So there was this mad rush in the last 3 or 4 years to spend a lot on content and on marketing, and that will be pulled back for sure. So the businesses ultimately will be more profitable, but will they replace the existing revenue streams with the existing business? I don't think so.
Jessica, I got 20 seconds. I'm so sorry. What's your single best buy right now? I got to make some money because I'm paying for Barbie Oppenheimer here 5 times for the family this weekend. What's your single best buy so I can make it back?
No, I'm going to throw 2 out. I would say Netflix, especially with the pullback, and Warner Brothers Discovery.
Great. Jessica Reef.
You satisfied with that?
Yeah.
You're putting money to work.
Jessica's always making me money.
Jessica, thank
I'll
you.
buy 2 or 3 shares,
On the streamers.
Can't
Doug
bet.
Cass wrote in. He said, is it so bad it's good? It's going to force these streaming providers to cut back on costs and make great content instead of just lots of content.
I don't know. I don't equate this to cable TV in its infancy, because there was a belief in a persistent cash flow as a utility. Coming up with the next Queen's Gambit the next Wednesday is not what utilities do. This is what Jessica Reef Ehrlich is legendary at. Gordon Crawford at Capital Guardian Trust, Paul Sweeney at Bloomberg, frankly, they're legendary at trying to gauge who will lose the least amount of money. They're all, as a generalization, losing money now. That's not a good position to be in.
It's going to force cost cuts. It's going to force consolidation.
But you
The
still
points
got to
that
go
Doug
out and
is
find creative
making.
winners.
Sure.
You know,
I mean, the strikes aren't going to go on indefinitely forever, are they?
No, the strikes always get solved, and it's based on the technological change of residuals to streaming and that. I get that, but it's an odd bit. I don't get it. When I talk to Sweeney about this in the 9 o'clock hour on radio, I just don't get what he's talking about. There's no profit.
Aren't these the same conversations we had about Netflix 2 years ago, 3, 4, 5 years ago?
Netflix seems to be like J.P. Morgan, they seem to be separate from the debate.
And everyone
maybe.
else is screwed, is that what you're saying?
No, I don't have an opinion on it. I just don't understand. The thing that drives me nuts, really, is in the old days with records, you knew at Billboard, you knew where everybody was at every moment.
Right.
Aerosmith is sold out in Iowa. Oh my God, print more records. It was that scientific. Okay, who's Nickelback? They're from Canada. Nobody will listen to it. Loverboy broke out here. Everybody's working for the weekend.
Oh, we got time.
Remember
We've
that
still
song?
got another minute. Keep going.
Okay, it's in the Barbie movie, folks.
But you missed that. I missed that on Sundays, finding out who was number one.
Yeah, I mean,
Sunday evenings.
with
I know.
streaming, it's all
I
a
know.
big secret. It's baloney. Who's number one on Hulu? I have no clue.
Who cares?
I'm not even sure I care.
let's be honest, who cares who's number one on Hulu? Does anyone care?
No
I
one
don't care.
cares. And that's to Jessica's point. That's the issue.
Okay. Sarah Hunt of Alpine Saxon Woods is going to be joining us shortly. Pushing ahead to next week, a Federal Reserve decision on Wednesday, the ECB on Thursday. This time next week, you'll hear from the BOJ. The following week, you'll get a decision from the Bank of England. Do you see the rent story coming out of the UK?
Hockey stick.
Seriously.
Hockey stick.
Great work from the team
London.
at Bloomberg in the UK. Rents in the United Kingdom, 28% higher than before the pandemic, in London specifically.
Yeah.
And outside of that, Tom, outside of London, very different story. But asking rents in London, the average I'm told
It's
now,
outside London, Kensington.
2,500. No, Kensington is very much in London.
And you lived in Notting,
In a few places.
Notting.
Equities right now on the S&P, just about positive.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
There's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Right now, it's all about earnings. So far, I think they'll come in fine.
It's a difficult market. This isn't an all-in type situation. This is being selective about the areas you want.
We still have a lot of money flowing through the system. That is a challenge for inflation.
We're not out of the woods by a long shot.
At some point, we do think the recession is going to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
You made it to Friday. Congratulations. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market positive on the session. It is up on the week. On the day, we're up by 0.25%. Teeing you up for next week. Big tech on deck. Earnings from pretty much everyone from Alphabet, Microsoft, Meta, and Amazon, with the exception of Apple. Apple coming in early August, and then a trio of central bank decisions. A triple header. The Bank of England's going to be in August, Tom. Before that, we get the BOJ this time next week, the ECB a week from now, and a Federal Reserve just around the corner as well.
We're having a lot of fun today with Jessica was just on with Barbie and all that stuff, baloney. There's a lot going on here into the end of July, not only Congress working in Washington, but I agree with you, the central bank derby really reframes and reshapes to get into autumn. And the one key thing they all have, even the Bank of Japan is a massive outlier. They're massively data dependent, like I've never seen. They're working on an ex post basis. Wait, and see what the data is. And you get a Rosenberg world like we just did, and that's a world of disinflation. Others push against
It's the mystery beyond next week.
Yeah, truly a mystery.
Fed hikes, ECB hikes, then what? BOJ, based on our reporting, there's been this talk, this suspicion that they tweak yield curve control. Ditch it, Tom, for how long now? Based on our reporting this morning, that's not going to happen next week, though it might be something they talk about.
Yeah, I think for us, it's 12 hours away. It's on the other side of the world, and we're really not focused on it. Global Wall Street will tell you this has Western ramifications. And when BOJ breaks, and with that you see strong yen. We haven't seen that. And what I'm watching is a backup not only in euro yen, but dollar yen at 142 right now. Anything near a 145, and the dialogue changes in Tokyo.
So FX market less interesting to me, actually, Tom. Bond market far more interesting.
Oh yeah.
If
absolutely.
you reset JGBs without their influence or involvement in quite the same way, how does that bleed into what's developing in Europe and what's happening here in the Treasury market too?
Yeah, I totally agree with that. And we begin with, in a Western basis, the Japanese bond market is an artificial market.
Well, it's not a market, yeah.
It's like something out of a book from Gnomes of Zurich of the 60s or 70s where they've controlled the bond market. The question is, what do we do as an analog in controlling our bond market? And that goes to the arch debate at Jackson Hole, is what do they do with a balance sheet at the Fed? That's maybe more important than the monetary ballet we're addicted to.
Have you forgotten a number of years ago we were talking about yield curve control potentially in America? Remember that? Wasn't that long ago?
It wasn't that long ago.
And
that's to the success of the institutions. Dr. Alarian will join us here to talk about these institutions, and they can take a victory lap that we're not talking about YCC now. I'll give them that.
You love giving the Federal Reserve a victory lap. You're like the only guy I know who thinks the Fed
Well,
deserves a
it's
victory
good.
lap.
It's an Oppenheimer as well. I mean, transitory is an Oppenheimer.
Okay.
He's talking about
Mohammed Al-Arian next hour. Let's see if he gives the Fed a victory lap. We'll have that conversation in a moment. In your equity market on the S&P 500, we're positive by 0.25%, up on a day, up on a week. And the bond market yields a little bit lower by a basis point, 383.69. That bond market story yesterday, Tom, disrupted by the jobless claims data, coming in lower than expected. That's good news. This labour market's still resilient, and you can put that Fed pause on ice, at least for now.
on ice, and again, data dependent here into next week in the jobs report, which is really, as I said earlier, all of a sudden, this is the Friday where Jackson Hole in August is upon us. This is the first day I've really felt it.
Just around the corner. Sarah Hunt joins us right now. Chief Market Strategist at Alpine Saxon Woods joins us around the table. Sarah, good morning.
Good morning.
You know, the conversation we're going to have, this market broadening out, you've got outperformance on the equal weight on the week against the NASDAQ, on the month against the NASDAQ. Are you positioned for that and looking for more of it?
Well, we were positioned for it originally, right? Because we weren't as heavy in tech as the NASDAQ was or the S&P was, because that's a very difficult position to be in, to have that much of your portfolio in those 7 stocks that were performing so well. But I think if you look at what happened yesterday and you look at what happened to Netflix and Tesla, the question is going to be around operating margins and the fact that tech is seeing some margin issues. Now, these are particular stories, so I don't want to extrapolate into the full of the technology spectrum, but I think the question going forward is, yes, you have a Fed now that is going to be looking at, we still have a very strong labor market, so the odds of them doing something in July are almost 100% at this point. And the question really is going to be, can companies continue to adapt and adjust and continue to keep their earnings where they are? And that is going to be the biggest question, because the expectation for earnings is going higher in the fourth quarter, and that's going to be a question.
We've had a huge response when you're on. We're trying to get you to come on daily, but your people won't let you. I don't oversaturation and all that. Sarah, you just absolutely nailed it, which is Netflix is in this crazy streaming business, as Jessica Reif Ehrlich just spoke about. It's not a tech company. It's a strange, creative, where's the next Barbie kind of thing. Tesla, I think, is an auto company, but maybe it's not. I don't know how people equate them to Google, Apple, Microsoft. I just totally, the conflation here of tech, to me, is borderline juvenile. How do you deal with that day to day?
Well, so I think that specifically on the earnings, you're right that Netflix and Tesla are very different than the rest of them for a variety of different reasons. But they also have both a strong first mover advantage, and also, for Tesla, obviously you have Elon Musk and you have that out front electric vehicle plus everything else that they can do. And with Netflix, they've been able to repeat some of those successes. And I agree, it's difficult to put a lot of stance in saying they can absolutely come up with a Squid Games or this every 6 months or every year. So the other tech companies, I think the question is really going to be around, how are they saving money? How are they, where is that margin going to come from if you are in a world where revenues might be coming down because inflation's coming down?
Microsoft's really worried about Squid Games, John. EBITDA pre-pandemic is $56 billion, and we're modeling $117 billion, a true double out to next year. That's not Netflix or Tesla.
Microsoft, those numbers drop on Tuesday. Amex, those numbers drop right now. American Express, second quarter revenue, $15.05 billion. The estimate, $15.36 billion. The outlook for EPS remains pretty much unchanged. Card spending. Let's talk about this, Sarah. This stock is up about 20% year to date. The airlines have done tremendously well. We've talked about them, the cruise line operators. Discretionary spending for 2023, I think, is a theme we haven't spent nearly enough time on because we spend so much time talking about big tech. You can learn something, as always, from the earnings as they come in. You can learn something else about how this market responds to those earnings as they come in. To see D.R. Horton yesterday come out with tremendous numbers and then finish the session lower, Amex comes out with a slight miss and gets punished in the pre-market. What are you learning from how we're responding to the earnings print so far?
Well, that started with the big banks, right? They came out with great numbers, and at the end of the day, those banks were not higher the way they popped on the original earnings. And I think the question becomes, are people reacting to the idea that maybe this is as good as it gets, right? So for D.R. Horton, what's the story? The story is mortgage rates are too high. People don't want to sell existing homes, so new homes are going gangbusters. So what happens when mortgage rates come down a little bit, or people start to go, okay, I accept those mortgage rates, and they start to sell the existing homes, and that number changes. So the question is that as good as it gets right now for D.R. Horton? Did we have the massive spend in 2023 on discretionary things like travel and entertainment that maybe people are going to start pulling back if things start to bite a little bit and their spending comes down? Because we're not talking about all that spending on goods where people are like, I got to have more patio furniture, I have to have another pool, I need all these things, right? So all of that's come back.
Yeah.
Is this a wave that is going to recede? And if it does, then things are almost as good as it gets for these companies in this moment. If oil prices are going up, that's tough for the airlines, right? Because that's part of their cost structure. So there's a lot of different things in play here, but I think part of it is, did we crest a wave here of spending?
This goes back to the earlier question then. So if you are a little bit more enthusiastic about this rally broadening out, and you've missed out on this rally in discretionary spending, and you want to take a position here on the cyclicals, is this a warning?
I think it's a little bit of a warning of some of the toppy things becoming less toppy, and whether or not that means that the whole thing, the whole curve of equities shifts down, which you don't usually talk about it that way, or you just start to see more people spending more time looking at some of the stocks like Parker Hannifin, which has had a great run, and they're a story where you're broadening out from short cyclicals to a little bit longer cycle businesses, and their margins are improving. So there are stories underneath the surface that can act very well. The question is, how do you cope with the fact that that the top is still so top heavy right now?
Parker Hannifin, PH, I got a 15% 5-year dividend growth. They're in boring, non-sexy stuff that never makes the Twitter zeitgeist on a Friday, and I'm clocking maybe it's a blended 17, 18 multiple. How do you discern Parker Hannifin as a value versus a value trap?
So Parker Hannifin has actually come up from where it was, and while they don't have any sexy headline businesses, they go into the airline industry. They go into all sorts of motion control, all sorts of things that are part of the industrial economy and also part of the leisure economy. If I'm building things for airplanes, that's a longer tail for a lot of that, which is part of the issue on flight costs, right? It's because we don't have enough planes in the air and we don't have enough pilots. But you go down into some of these secondary suppliers into the industries, and I think that there's some real opportunity, especially companies that are able to expand their margins.
John, fluid systems, flight control, hydraulic, fluid conveyance, drinks in business class, whatever. That's what they do in Cleveland. 55,000 employees. These are the kind of stocks that just haven't participated, and you're like, when's the when? Is sort of it. 16% per year. Last decade.
That's the conversation we're having right now. Let's finish on an area of the market that had participated for several years. You know exactly where I'm going because I finish every conversation you and I have together on this sector.
So predictable.
Energy. What's going on?
I wanted to pick a different stock just to change that. We still like energy. I look at the LNG sphere, and I look at Cheniere in particular. I look at Chart Industries. I look at companies that are participating in both the LNG space, but the general hydrocarbon space. Again, this is a long tail. There was some discussion on Bloomberg a couple of days ago about this. One of the catalysts for oil is that you just stop releasing it from the SPR. Even if we don't start buying it back in huge amounts, there have been releases that have been ongoing all year, and we don't talk about that anymore, but you have extra supply that's added to that market. So when that starts to come off, and if you don't see a collapse in demand, right? So that's the other thing, is that are commodities telling you, is oil telling you demand is coming down? I think the issue has been more about on the supply side than on the demand side, but China is definitely an issue for that as well.
Well, just to be clear on China, for this trade to work, do you need more stimulus from China or not?
It would certainly help, but longer term, I don't think you need it. I think that the general use of hydrocarbons is still growing even without China. So that they have been also releasing some of their SPR. So they start pulling oil back in, that also adds to the demand picture. So I think it would be helpful, but I don't think you absolutely need it.
Sarah, you knew where I was going. It's good to catch up. Sarah Hunt of Alpine Saxon Woods. TK, on an era of this market that led for a couple of years and has lagged this year at least.
Yeah, I mean, I look at Cheniere, it's only up 19% per year for the last decade. And I mean, you know,
Well, you know the story of it, ain't the NASDAQ is not happening. It's kind of been like 2023, right?
Yeah, we're all focused on like literally seven stocks. Yeah. And that's it. And then you got a Cheniere out there with a ginormous dividend growth. It's trading like at a multiple of 7. I mean, it's ridiculous.
If you are just tuning in, welcome to the program. Your equity market on the S&P 500 positive by 0.26%. Coming up in about 47 minutes' time, we're going to catch up with this guy right here, Mohammed Al-Erin of Queen's College, Cambridge, in the studio here in New York City. TK, that'll be cool.
You know, you think he's coming in to see the New York Jets and Aaron Rodgers. No, I'm in the surveillance nap yesterday with Vet Bill and Kennel Fee, and we're all snoozing away and the phone rings. It's Al-Erin. Tom, you're talking to Arsenal. I happen to be in town. I mean, that's, folks, that's what this is about. We're going to be talking to one of the great executives of one of the great sports successes here. And Ilarion really getting his elbows out on this says, I'm available.
Arsenal have spent a significant amount of money this summer. Yeah. Serious money. Declan Rice, 100 mil.
I have no idea. Talking about.
You read the sports pages, you know exactly what's going on.
Yeah.
Vinay Venkateshan coming up, Tom.
Can he do anything about Harry staying with the Tots? I don't think he can.
No.
I mean, they're like arch rivals. Help me here. Arsenal and Tots are arch rivals.
I'm sure that he would love Tottenham.
What's an Arsenal fan like compared to a Tots fan? What's the difference?
Compare the two fans?
Yeah, please.
If I do that, Tom, I'll offend somebody.
Okay.
So I'll avoid that entirely. In about 15
minutes.
Go
to the cigar bar at the Lanesboro.
Winnie Caesar of Credit Sites on this credit market. In about 5 minutes, we'll catch up with AMH down in Washington, D.C. From New York City, equities firmer. This is Bloomberg. Good morning.
City, in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make a decision.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Let me be very clear. Friendshoring is not for an exclusive club of countries. It is open, it is inclusive. The United States is working to strengthen, not to weaken, our ties with the emerging and developing world.
Janet Yellen, the US Treasury Secretary, on friendshoring. Tom, if friendshoring's not exclusive and open to everyone, then what on earth is it?
What is friendshoring?
It's meant to be that you have closer trade ties with your allies. Another term might be nearshoring. So for the United States, as an example, might be you have a closer trade relationship with Mexico or Canada, as opposed to China. You diversify and or de-risk your supply chain by relying
you're
on
pulling all the strings today. Is it because I wore my
closer
beige
allies.
suit? I wore my beige suit, and you're like,
I haven't said anything about your beige suit. I've not said anything.
Well, you don't have to say anything. It's just a look. It's like we're sombrero. But
it's the shoes. It's not. It's the shoes people can't see.
It's going to get. Come on, it's like Ken. Surveillance Ken.
Okay.
That's what we're doing today. The thing that's important here, and this goes back to Secretary Clinton and fair trade. They're trying to emotionalize globalization, deglobalization, a la Stiglitz, and the reaffirmation of what kind of regional bloc or fair trade we're going to have. And it's not wrapped around all this touchy-feely stuff. It's wrapped around real tough negotiations.
With a fear of offending people.
Yeah.
As, you know, they've used this word de-risk and now they're not using it. Decoupling got thrown around. They don't want to talk about decoupling. The new word that Secretary Yellen used in the last couple of weeks was diversify after going over to China.
I still don't know what that, you know.
At risk of offending people.
You know.
Ultimately, Tom, it comes down to one thing. It's moving your supply chains out of China.
Thank you.
And moving them closer to home.
Yeah, and that's what it comes out to, and that's the experiment. We're going to pick up on this right now. In an odd Friday, we speak with Anne-Marie Horton off of her interesting conversation with the Secretary of Treasury. She's our Bloomberg Washington correspondent. We could do a 2-hour conversation this morning, Anne-Marie. I'm going to try to cut it down to an hour and 15 minutes. On China and on our trade strategy in a sleepy July onto an even more sleepy August, are Republicans and Democrats on the same page in terms of a trade strategy?
Well, if you look at some of the controls that are in place and tariffs that are in place, you would think that they are on the same page. And
yes.
First top of mind comes to the Trump-era trade tariffs that then this administration kept in place. That is still actually under review, but it doesn't look like they're in any hurry to get rid of these tariffs. Politically, if they were to, that would be very difficult, especially going to election. So you look at some of these items that the administration, the former administration did, the current administration is going up against. They're going to be unveiling as well an outbound investment executive order. And you think that they would both be on the same page. But of course, we are heading to election year, and the rhetoric is really going to start to ramp up. Already, we had Chris Christie in the studio this week, the former governor of New Jersey. He is a candidate on the Republican stage to be the nominee. And he was saying that he would change his tone and come from a place of strength. But what does it exactly mean? Because everyone knows that once you also get into the White House, you have to navigate this relationship and also make sure that you are not just being strategic about it, but also responsible about it. And the rest of the world does want to see a responsible dialogue between Beijing and Washington.
You have massive cred on continental Europe, Putin, and this war. And to me, in the distractions, including the silliness over Barbie and Oppenheimer, it seems almost that we have a war unraveling this week of July. And the focus, New York Times, Washington Post, Bloomberg, and all, is to the south in the Black Sea. What is the Pentagon doing about that? What is the Navy doing about the new tensions in the very south of Ukraine?
Well, I think at the moment what everyone's trying to do is find a diplomatic way out. Russia has complained about the Black Sea grain deal in the past, and you have seen these tit-for-tat verbal bars between Moscow and Kyiv on what that would mean to ships entering the Black Sea. But they are trying to find a diplomatic way forward. You have Zelensky just moments ago saying he's instructing his top military commanders and Navy chief to prepare actions that would allow the grain deal to continue. And you have President Erdogan of Turkey, who has been influential in the past to get this deal done in the past, or extend it really in the past, alongside the United Nations, saying that he's going to talk to Putin about it. But obviously that's where their focus is, because Putin just ripped Russia out of this grain deal that was operating somewhat smoothly. We should note that Russia has attacked Ukrainian agricultural infrastructure in the past. But it was really important, especially to the developed world. You know, you talk about what really matters when it comes to inflation. Food inflation is key to the developing world. And not only do you have this grain deal being torn apart, but also the fact that this week, India also has announced a major end to a rice export. They are the biggest exporter of this type of rice. All of this could be inflationary to these really important developing countries.
Let's talk about the Secretary of State. Not Antony Blinken, Henry Kissinger. MH, have you had any response from the White House about the diplomacy that seems to be conducted by the former Secretary of State?
So what we've heard from the State Department is that they are aware that Henry Kissinger was making this trip to Beijing, the former Secretary of State, and from the Nixon era, but that this was not part of a diplomatic push from the Biden administration. They say he is there in his own capacity as a citizen, which he has done in the past. It's very interesting because between Tony Blinken going just a few weeks ago. Then you also had, at the same time, Henry Kissinger was there, another former Secretary of State, John Kerry, and then, of course, Henry Kissinger. The Kissinger meetings, for me, are really important because he got a sit-down with Xi Jinping, who called him an old friend, but even more important, he got a sit-down with Li Shangfu, China's defense minister, an individual that snubbed Lloyd Austin and the Pentagon's outreach for a sit-down because China wanted to see sanctions lift on this individual that the Biden administration just wouldn't do. But they were willing to sit down, even the defense minister, with Henry Kissinger. All of this is the administration has been trying to get meetings between Washington counterpart and Beijing counterpart. So it's a very interesting moment because Henry Kissinger seems to be navigating these politics in China, but is not doing so officially.
It's amazing that he has access that this administration can't get. Anne-Marie, just go a little step further if we can. Do we have any insight as to whether his views on that relationship align well with the views of the administration of the White House?
Well, Henry Kissinger wants to see China and the U.S. be on more friendly terms. I think that's obvious. Even him just taking this trip shows that is obvious. He first made this trip in 1971 when he met with the head of China, talking about re-engaging between Beijing and Washington. So he obviously wants to see a friendlier path between the U.S. and China. I couldn't speak to what he makes now of things like export controls and the tariffs, but he definitely wants to see better communication between the two, so much that at 100 years old, he is making this trip to Beijing and sitting down with a number of individuals and having really the red carpet pulled out by Xi Jinping for him.
Incredible stamina to still be making trips like that. Amazing. AMH, let's finish with the question Tom's asking everyone. Do you, or don't you, have tickets for the movie this weekend?
I do not have tickets, but I plan to see both of them. We spoke to Kai Bird yesterday, who wrote the biography on Oppenheimer, and now I was even more compelled to make that the first choice I'm going to go see once I finally get tickets.
Got to find tickets, TK.
Wait. Did you have
next weekend?
Did you have
we'll
the
Barbie?
Anne-Marie, did you have the Barbie convertible when you were a kid? I can just see the hoarder in the house, just the whole living room, just.
That is exactly what it looked like. The entire living room was just Barbie houses.
For the Barbies.
Little shoes.
Oh, yeah. Oh, come on, John. You don't know the plot. I mean, they got to go to Venice Beach here.
Oh, no spoilers,
there, and
TK.
weird Barbies there.
Don't spoil the movie, Tom.
Look, it's real simple. Let's take it over to surveillance and surveillance Ken, okay? And I'm trying to do it this morning.
Is that why you're wearing a boat?
Yeah, you got it right, Emery. There's John, and there's Bramo, and there's stereotypical Tom. I mean, it's just like, it's just like Barbie. That's the way we live every day.
That's the Barbie movie.
That's the way we roll.
This is like the Barbie movie.
Yeah, we're going to Venice in the convertible.
No idea what
Anne-Marie's
that means.
coming with us.
Winnie Caesar of Credit
Bramo's
Sites.
in Norway.
Up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Trying to finish on a high going into the weekend on the S&P 500. Equity futures just a little firmer, higher. Traveling north, Tom, up 0.2% on the S&P. We're up by 0.45% on the NASDAQ 100, following the worst day since February on the NASDAQ after a tremendous year so far year to date in 2023. Down on the session on the NASDAQ 100 for a second day, down on the week as well, actually, even with the S&P poised to squeeze out a weekly gain. Into the bond market, looking ahead to next week, the Federal Reserve just around the corner. Yields unchanged today, but higher yesterday off the back of more resilient labor market data in America. It just keeps coming. The 2-year, Tom, 484.15. The 10-year, 383.69.
I say collared around the data, collared around what we're going to see in earnings next week. We'll have full coverage for you. That folks deep diving into August 3rd, I believe, is Apple. I'm going to go to levels instead of change analysis, John. And we have to remind ourselves on a close yesterday, 35,000 Dow, 4,500 SPX with people rationalizing higher. NASDAQ 100, dare I say, on the vicinity of 16,000. These are levels 6 months ago. John Authors and Isabel Lee have an absolutely spectacular article today, fairly, without any ill will. You'd never get ill will from John Authors. It's a complete
not at all
class act article on how difficult it's been for the strategists. It's a tour de force.
I'll tell you the one to reach out to, Lou Wang in Bloomberg News. Yeah. Surveys everyone all the time.
Yeah.
She's the one that puts together those surveys on the Bloomberg, Tom, of equity strategists and their year-end price targets. And a lot of them have had to hike them. You know who hasn't? We talk about Mike Wilson a lot at Morgan Stanley. Greg Barrel at BNP Paribas.
BNP Paribas, writing about him.
Rock bottom. I think still 3,400 on the S&P for year-end, which would be something.
And the outliers, Cantor Fitzgerald goes from some optimism in getting it right, and they really have a very cautious view forward. But I'm going to really emphasize this, folks. I'll get it out on Twitter. I've been too busy. The John Authors, Isabel Lee article should be CFA level 1 reading. I mean, it's got 4, 5, 6 charts without any of the snarky, malicious crap that you get out on the zeitgeist. It's a brilliant tour de force of how tough this business is.
No need for the stark.
Yeah.
As you say, this is a difficult job to try and make these calls. Let's get into the FX market just briefly. I want to talk about the euro. Later we'll talk about the yen. The euro actually on a weekly drop this week. Could be the worst week going back to May. The euro had a look at maybe breaking through 113 in the last week. It's all the way back down to holding on to 111. 111.25. We're negative on that currency pair this morning by 0.05%. Under surveillance this morning, going into the Federal Reserve decision next week, former Fed chair Ben Bernanke, which some of us say, in a webinar hosted by Fidelity Investments, is talking about maybe next week's hike being the last hike, Tom. He said this: what we'll see is a very modest increase in unemployment and a slowing of the economy, but I'd be very surprised to see a deep recession in the next year. And this is the hopes and dreams of pretty much everyone, that you can get a softening of inflation without a big drop-off, Tom, in growth.
Pull out the word deep there, and for people that aren't up to speed on this, and particularly all the great work of Bernanke of Princeton on the history of America, there's different levels of recession. Not only the early 1980s, a Volcker double recession as well, but deep is a key word there. And if you get, let's say you get a true NBER recession, but it's shallow, like I think it was 01, my recollection. I can't remember exactly, to be honest. But the answer is deep recessions where the gloom crew is, and there's a lot of people like Bernanke pushing against that.
Central bank trilogy next week, ECB, Federal Reserve. BOJ about a week away. This is the standout in the FX market this morning. These moves in dollar yen are reporting suggesting, Tom, and guess when that reporting started to come out a little bit earlier today on the BOJ, that the BOJ is seeing little urgent need to address the side effects of its yield curve control. Yen's a whole lot weaker. Dollar yen 141.79. That currency pair positive by 1.2%.
I looked very carefully into the early evening last night of the inflation makeup in Japan, and there's different levels. There's Tokyo inflation, nationwide inflation, X this, X that, X energy, and the rest. And the answer is they've manipulated a 3% plus inflation. And the question is, and this is the folly of it, how do you manage 3% inflation? No one's ever done that before. Not the Japan. No one's ever done this. It's a unique experiment.
It's worth repeating, and I know you and I have talked about this a few times. The way Japan views this inflation compared to the way Europe, the UK, the United States views it is just so different. They seem to view this, based on their communication, they appear to view it as a generational opportunity to reset inflation expectations higher. And that is just not the way the rest of the West sees this inflation dynamic.
It's in none of the textbooks. And what I'm going to go to, John, is what I think is the foundational idea, and I've seen it in the zeitgeist a little bit in the last 2 weeks on Europe, is you just look at the glide path of nominal GDP. The Japanese are clouded by a terrible nominal GDP. Italy is clouded by a terrible nominal GDP. And coming out of the pandemic and the Biden stimulus, America goes the other way with an outstanding relative nominal GDP growth.
This is the central bank triple header for next week. BOJ, ECB, Federal Reserve. Double header this weekend. TK, you're all over this story going into the weekend. Barbenheimer, right? Barbenheimer. Yeah. Barbie, Oppenheimer. Here's the range of estimates. You've given us your estimate, Tom. The pre-release sales for Warner Brothers Barbie suggesting it could bring in 140 to 175 million US dollars. Amazing this weekend. Universal's Oppenheimer expected to make something between 50 to 70.
I'm going to call Oppenheimer a serious movie and Barbie, whatever the fiction, and I mean that very constructively. It is.
Is that the official review?
My review is they're two very different movies, but what they're not is Marvel or Star Wars or the other big events, frankly, that Iger's been famous for in developing brilliantly at Disney. And so it's like a new leaf, and I can just imagine creative Hollywood parked, let's say, on the edge of the pool at the Sunset Tower Hotel, praying in near religious fervor that even with the strike, both of these come up roses.
Something original. Right. It feels like it's been a decade of just repeating.
Mark Ronson is doing the music for Barbie. They got all the heavyweights in here, top to bottom. And, there's the Venice Beach image. For those of you on radio, we're showing the visuals right now, the bright pink and the somber beiges of Matt Damon and what's going on with Oppenheimer. And the bottom line is, John, Barbie captures Venice, stereotypical Tom and Ken and stereotypical John.
Tom and Ken.
Yeah, there's Weird Bramos in the movie.
Tim, what?
Weird Bramo's a character in the movie. It's really important. And they're all going to Venice Beach to save themselves.
Okay.
That's the plot.
Well, you watch it this weekend and you let me know.
I got a preview, they sent me
I'm all for Cillian Murphy and Oppenheimer. But that's one for next weekend. I can't get tickets for this weekend.
Well, yeah, Afterthought has tickets. I don't.
You want to talk credit?
Yeah, let's talk credit.
Let's get away from that. High yield spreads are so tight, TK. South of 400 basis points, one of the tights of the year so far.
Let's go to a Bramo conversation.
We can have that conversation right now.
Yeah, let's do it.
Junk bond yields, incredibly low relative to the risk-free rate.
Winnie Caesar joins us now, Global Head of Strategy, Credit Sites here. And Winnie, let's really drill in on this. It's maybe not in the short-term space, but I'm going to, we miss Bramo. She's off Norway somewhere with polar bears. And, Winnie, I'm just going to look at the absolute miracle of price up, yield down, in middle grade credit and even in the high yield space. Let's start with the why. Why are bonds doing so well that have a higher yield?
Well, I think that the high yield bonds are definitely living in a bit of a Barbie world. It's been a fantastic setup with higher yields, with investors looking to add yield to portfolio, with defaults not manifesting to the level that people were perhaps anticipating last year, and with the broader macroeconomic backdrop appearing like a softer than expected landing could materialize. High yield looks pretty compelling overall, especially relative to some other asset classes, including things like small cap equities.
Okay, so you're using them as an equity alternative. Help me here from your mortals. What kind of yield can I gather even with high yield and middle credit price to perfection? Am I looking at a 4% yield or can I do better?
Oh, you can do double that. In the double B space, you can get somewhere between 7 and 7.5%, and that's even on the front end of the curve. You don't actually have to extend duration all that much, just given the current shape of the yield curve. The single B land, which people tend to get a little bit more worried about, especially in an eroding economic environment, is doing quite well from a fundamental perspective. And there you can capture yield of somewhere between 8 and 9%. So from a forward 12-month basis, if you're willing to withstand a little volatility, because rates volatility is still elevated, and that's going to flow through to the high yield bond market, forward returns look pretty attractive overall.
When the Fed preaches high for longer, high hasn't hurt credit. Let's talk about when longer will. Is there this maturity wall on the horizon that if the Fed sticks with 5.50, maybe even higher for the next 18 months, that it starts to become a problem for some of these creditors?
So we do see in the lowest rated segment of the high yield market, and then also the lower rated segments of the leveraged loan market, there has been some pretty significant fundamental erosion. We've seen interest coverage levels drop pretty materially, especially for CCC loans. And as we look to maturities in 2025, which is really when that maturity wall starts to build for leverage finance, that's when you start to see a little bit more stress come through the market. Now, when we do sensitivity analysis around the aggregate impact of these higher for longer yields on the market, the moves in interest coverage on an aggregate level actually don't look all that terrible. So it's just that kind of isolated, highly leveraged, not particularly great capital structures to begin with segment.
Winnie, you mentioned the small cap space, and this is outside your remit, so if you want to cut me off, you're not the first one this morning. But, Winnie, I look at the yield space, and I look at a given vanilla ETF, high yield, whatever, and I'm looking at a track record that pales as compared to the 7 great tech stocks. Retail America is addicted to owning big tech. What is the attraction of your world right now to people addicted to 19, 18, 17% per year moves?
Well, that's a really good point. And one of the things that we've been looking at in the high yield market specifically is figuring out that investor composition. Where are the next investors stepping into this trade going to come from? And historically, you need to see either retail investors or non-US investors come into the high yield market to really push spreads toward new all-time tights or towards cyclical tights. We're not expecting that in our base case scenario. We think with defaults rising even modestly and a relatively strong US dollar compared to the other majors, you have a harder time getting that retail interest or that non-US interest into the US high yield market. And so I do think that there is the reality that some of the kind of name brand issuers in the equity market, also in the investment grade corporate credit market, we're still quite constructive, are probably going to be the ones where you see that more kind of global and retail interest overall.
Winnie, thank you. Winnie Seether there of Credit Sites on the credit market, pinpointing maybe 2025 when those high interest rates start to become more problematic for some of these companies looking to refinance. If you are just tuning in, welcome to the program. The S&P 500 positive this morning by 0.2%. Elsewhere in the bond market, yields are lower by a couple of basis points, 383.29 on a US 10-year. The conversation, without a doubt, is going to shift to football a little bit later this morning, in about 30 minutes from now.
Have you been to Arsenal?
The Arsenal CEO is going to be joining us. I've been to an Arsenal game. Been to the North London derby, Arsenal-Tottenham.
How's it different than the end zone of Liverpool? I mean, is it nuts?
Okay, I'll say
West
this.
Ham nuts?
The atmosphere at Anfield, and I haven't been to Anfield before, appears to be better than the atmosphere at the Emirates. That's
This
me
is
being
one of their
diplomatic.
songs. We are the Arsenal boys. If you are a Tottenham fan, surrender or you'll die. Do I want to do this interview?
That's not the actual Arsenal song for Tottenham. That's one of them. No, but there's a better one.
Is
There's a better one.
that's the one that could go to air on
Google,
radio
it
and
begins,
TV?
what do we think of Tottenham? That's how the Arsenal song goes.
O2.
But you should Google that. I don't want to do that on it.
O2.
Okay.
O2,
Yes,
O to B.
What a Tottenham.
What's a gooner?
What a Tottenham, and then you can see what they say next. You sing something back, Tom. Anyway, equities right now on the S&P positive
These people
by
are nuts.
0.2%. Win thinner, Brown Brothers Harriman coming up. Your equity market just about positive from New York. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I think the Fed's doing a very good job. I think this, what we're in the middle of right now is a Fed that has slowed to the pace of a rate hike every other meeting. We're all expecting a rate hike next week, right? That's in the cards. Then the question is, what kind of signal do they give us for September? And then the timing of the next possible rate hike is October-November meeting.
Well, you can bottle that, frame it. Peter Hooper at Deutsche Bank with this quote: I think the Fed is doing a very good job. TK, you're not alone. You've got some company.
Oh, you've got some company that goes back to Arthur Burns here, and I think the debate here is the correct debate, as Dr. Alarian led on. He'll join us here in a bit, which is this is a Fed that delayed and, given a natural disaster, tried to apply traditional monetary theory with calmer. I wouldn't have a lot of, I wouldn't be too forceful here if I was the Fed on how brilliant we are. I think it's an interesting 6 months of mystery ahead.
I doubt they will be next week.
Yeah,
far too
humility is
far
entrenched
too
there.
early. Mohammed Al-Arian coming up in about 15 minutes'
Yeah.
time. Let's turn to the price action just briefly. In the equity market, futures are positive on the S&P, up on the day, up on a week. In the FX market, dollar-yen rising for 4 consecutive sessions. Today, biggest one-day pop going back to April, a move of 1.2%, reporting suggesting that the BOJ is not going to back away from yield curve control anytime soon, TK, the BOJ meeting this time next week?
We're going to dive into this right now. And for Global Wall Street on a Friday, we're distracted by the silliness of Barbie or this, that, and the other thing. Well, guess what? There are serious themes ahead, and they are by definition complex. Joining us now out of Columbia, his work for years at Brown Brothers Harriman is Dr. Win Thin, head of currency strategy on Japan. When I need a clinic right now, we'd go to Robbie Feldman at Morgan Stanley or you at Brown Brothers Harriman about what they have wrought in Japan. Was it a cultural decision in Japan to rip up the textbooks you studied at Columbia? Was it a cultural decision to impute inflation into the system?
Well, hi, Tom and Jonathan. Thanks again for having me. I don't know if it was culture as more just of pure pragmatism. Remember, Japan has been fighting deflation for decades. And I think they're really quite gun shy about removing accommodation. I think markets kind of got ahead of themselves about either a tweak in yield curve control or eventual liftoff. It's clear from the Bank of Japan comments and from the policymakers in Japan that they're very, very concerned. The numbers are starting to turn over right now, not only domestically, but obviously globally. And so they are really, really reluctant. And so I think that's the signal that's coming through. Of course, look, they can surprise us next week. They love to surprise us, but this is not a time for surprises to me. I mean, I think there's so much going on. Tom, to your point, this is a really crucial quarter or maybe half year for global markets right now.
On an algebraic process, there has to be constraints on whatever the variable is, whatever the process is, whatever the derivative is within the function. To me, the constraint is they want to own the bonds, but they can't become the bond market. Has the Japanese government become the bond market? The ownership of the bonds is by the government and with the government, where the algebra doesn't work anymore.
Tom, I have to be honest. I get anytime like a young economist or young analyst asks me about what's going on in Japan, I really sort of start getting a headache because it's hard to explain. Yes, the Bank of Japan owns about half of the JGBs in the market, and it's just something that's hard to explain, right? I mean, we don't see that anywhere else. But I think the big difference is that Japan is a nation of savers. They're not dependent on foreign savings. So it's sort of this almost like a little domestic little bubble of an experiment that so far is working. But again, I think they're very, very worried about how to get out of this. They've been stuck in this mode of buying and easing for so long that I think they're very, very scared about.
John, this is precisely the point. They want to do an action, which is to get out of it, and they have this massive constraint that they own the bond market.
Oh, they dominate it. Yeah. Hardly anyone else does. When the problem, though, I think that you could get is the kind of spillover effects from anything they do, say, to the European bond market, to treasuries. How would that work? What would the dynamic be? Would it be Japanese investors coming back home again? How would you think that would work?
Yeah, Jonathan, I think there's quite a few channels. But the main thing would be, obviously, if they abandon yield curve control, JGB yields would most likely shoot up, and you would have a spillover effect of, I think, pushing up U.S. Treasury yields and German bond yields, et cetera. They've been, again, the outliers. Japan is the sole outlier. Every other central bank is hiked aggressively. And it's the third biggest economy in the world. So it's to me, it's there. There's just a very potential negative spillover to bond markets. Now, in terms of currency markets, we would see the opposite. We would see the dollar yen most likely knee-jerk go down if there's any sort of removal accommodation. Again, that would have spillover effects on the regional economies. Again, this is such a crucial time for global markets, and especially Japan, that I really think that caution is sort of the watchword right now. I don't think they're going to surprise anyone. I don't think they're going to take any kind of drastic action. That said, again, they love to surprise us, so we'll know more a week from now.
We're going to find out in a week. When I wanted to finish on Europe and the experience we had there, for many people, including myself, I had my doubts about the ability of the ECB to hike interest rates, to back away from QE, given developments over the last 10 years in places like Italy, Spain, Portugal, Greece. They've been somewhat successful taking away that stimulus and not seeing big accidents develop in the European bond market. Do you think Japan can take that as an example where you could find some success? You can get that handoff away from central banks owning everything and then handing it back off?
Well, two things. I think Japan is such an extreme example, but yes, I think there is some hope that they can manage this. But again, I think the best time to have done this when markets were doing okay. In a sense, I think maybe the Bank of Japan was a little bit too late by waiting so long. The other thing I would say about Germany is that there are even some cracks there. You've probably been covering how noted hawks not and another one just have been backing off about a September hike. And that's the first time I've heard the hawks really sort of back off from this really intense tightening cycle. And I think that's because peripheral countries like Italy, Portugal are starting to complain. They are seeing cracks form in the Eurozone. I think that's something that's helped the Euro sort of top out in recent days.
Is the Bundesbank we know in? I mean, is the Bundesbank the inner core that Martin Feldstein would talk about for years? Are they still entrenched in an inflation worry?
Yes, absolutely. And then it just occurred to me that Mr. Nagel, the Bundesbank president, is the other hawk. Slipped my mind there. He was also one of the ones that cracked. So it's interesting. If anything else, that the Bundesbank has gotten, I think, at least changed its worldview. They realize it's not just all about Germany. There are other countries that have to be sort of within the calculus of the ECB. And I think when the ECB first started, they were still locked into that 1980s, 1990s mentality. And I think they were seeing a subtle shift. We'll know more next week. We have the Fed Wednesday, ECB Thursday, Bank of Japan Friday. To me, I think what's going to come out of this is that the U.S. dollar, the Fed remains king. ECB, Bank of Japan will start to sort of blink, perhaps, and I think that we can get a little bit higher in the dollar in the coming weeks.
Interesting. Win Thin of Brown Brothers Harriman. Win, thank you, sir. Thanks for the insight, the input there on the FX market. We caught up with Eric Nelson of Wells Fargo just yesterday, who agreed with that last point that Win Thin made. Save the quote for us, Tom. For the dollar to weaken much more from here, I think you need to see the U.S. labor market deteriorate rapidly and/or see global growth prospects improve materially. That's his take.
I'm so glad you bring this up because it strikes me as the same as the disinflation theory, and that the disinflation continues a la Rosenberg. Disinflation levels out many. Disinflation reverses and inflates a la Bianco and others here. All of that is a function away from price change with what the labor market does. I don't think it's any different.
FX market, the euro right now, 111.26. We talked a lot about that yen weakness against the dollar, 4 days of it, dollar yen through 141 and having a look at 142 this morning. In about 5 minutes, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge, joining this program, TK, to break down this market and look ahead to that central bank triple header next week.
Here, I'm intimidated. The guy from Queen Parks Rangers is going to show up. Who is Declan Rice most like? Which is the player he's comparative to?
That's a good question. You asked me if he was like, who did you compare him to earlier? You asked him if he was like Grealish. No.
I love watching this Grealish guy.
Sits a bit deeper than that, Tom.
Down in half, he's like half-backy.
But he's a quality central midfielder, and let's see how this develops. I think there's a lot of weight, pressure on his shoulders. When you get bought for 100 million sterling, Tom, that's a significant amount of pressure on you to perform. And we saw, you mentioned Jack Grealish, he struggled with that first season at Manchester City. He struggled with that burden and talked about it himself.
Jack Grealish, for those of you in the real world, Jack Grealish reminds me of a guy named Cam Neely who played for the Bruins. When Cam Neely got the puck, John, it was like everybody else was standing still, and that's what it's like.
Well, it's exciting,
you know, the ball.
Just things light up. Do you know who was the best at that, I think, in the last 15 years, 20 years? Ronaldinho. Yeah. Have a look back at the videos of Ronaldinho. Just every time he got the ball, it was just this level of excitement that didn't exist with any other player.
I'm up at 3 a.m. talking to Neil Millington at the Lanesboro about that. Neil, tell me about Arsenal, please.
Mohammed, coming up next.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects there needs to be an understanding, the user needs to understand the level of data that it's collecting and then be the one who says where that data goes.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody? The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
We're all expecting a rate hike next week, right? That's in the cards.
We're kind of on a bit of an easing trend on inflation, and the Fed is, seems comfortable hiking slower.
I actually think we're going to see some deflationary pressure, so that's going to kick in.
The Fed, in their tightening campaigns historically, were unable to give us a soft landing.
We're expecting a comparatively dovish hike next week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On a Friday, deep into the summer, we welcome all of you on radio and television. Ian Linga nailing it there on the raging debates. And this hour, Mohammed El-Arian will join us from Cambridge, from Queen Park's Rangers. Got 8 things to talk about. We're going to talk about Arsenal. We're going to talk about Budapest and what Ricardo's going to do this week. My head is spinning over entertainment, and the major entertainment economics is we have no clue where we are in 90 days.
He does not want to talk about QPR. Let's just put that on the record ahead of the interview. We want to talk about a triple header from central banks next week. The ECB on Thursday, the BOJ this time next week. The Federal Reserve kicks it off on Wednesday, and some people saying one and done, and that one, Tom, comes next week.
They're just data dependent, and we can talk to Dr. El-Arian about this. I want to talk to him about R-Stard as well, the raging debate out there. But the number one thing is, you mentioned Bernanke and under surveillance here earlier. The idea of the level of ex post that these central banks are, they are waiting and waiting and waiting to get data clarity.
You need several data points like the one we got a week ago. You need maybe more than that before this central bank starts to remain committed to this idea that we're on course towards a soft landing. Have the chances improved? Sure. Yeah, they have. But after the mistakes this Fed has made, do you think they're going to fully embrace one data point and back away from everything they've done in the last 12 months?
No, they're not going to do this. And, people go, okay, why is El-Arian on? Okay, it's game theory. And the key idea here is to make a T decision with clarity and confidence. A, you can't do a T decision out of a pandemic because we're making it up as we go. And B, we can't do it because we got a war in Ukraine. We're making it up as we go. We got China exiting wicked late from COVID. And so T decisions are out of the question. I don't know what Valerian's going to talk about. He can't talk about his acclaimed T decisions.
You and I are making it up as we go as well. Your equity market on the S&P 500 positive by 0.2% this morning. There's a lift in the equity market. Bonds pretty much unchanged at 384.47. In the FX market, euro a snooze. On the week, though, interesting. The euro's shown some weakness. The biggest weekly loss we're poised for on the euro against the dollar going back to May. And there's a big move in the dollar yen as well, Tom.
Bigger move.
Dollar yen. Positive by 1.2% and some this morning, pushing 142 as reports suggest they're not going to consider backing away from yield curve control next week.
What the pros do is they take the dollar out of it and then they look at the triangulation. I'll get 3, 2, 1. Triangular. I can't do it. Anyways, they look at euro yen and the answer is euro yen out 1 full percent out to 157. You get euro yen out to 160, and that's the tension that leads to the unexpected.
Let's bring in the
unknown
guest.
unknowns.
Should we get to the guest?
Let's get to the guest. He'll say this.
Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge, amongst many other things as well. Mohammed, good morning.
Good morning. Thank you for having me.
Thanks for being with us. Central bank triple header next week. What are you focused on out of those three decisions?
So all three are going to hike by 25 basis points, but that's where the commonality will end. I think the Fed will come across as dovish. The Bank of England will still be quite hawkish, and the ECB will be in the middle in terms of their forward policy guidance.
Fed one and done or more to come is a question we keep leaning on. Where are you on that now?
So the framing matters. If I go to your framing, which is to adopt the excessive data dependency, which is where the Fed is today, and if I stick to a 2% inflation target, then they will keep open the possibility of a September hike. If I go to a different framing, which is a much longer-term framing that looks at how the U.S. economy functions, then it should be one and done. The trouble is that we have all been pushed into this very short-term framing where it's almost absurd that we talk about data dependency with policies that act with a long and variable lag. But that's where we are.
We're long and variable lag, but what we really are is trying to measure some form of algebraic plugins that lead us to a phrase restrictive, or as Dominic Constantine-Mazzuo says, super restrictive. Are we super restrictive right now?
We are restrictive. We're not super restrictive, but we are restrictive. But, Tom, it brings you back over and over again to a question that hardly anybody wants to talk about for understandable reasons, which is what is the right inflation target for the world we're living in today? For a world that I believe is a world of deficient aggregate supply, not a world of deficient aggregate demand where we had been. So that's where it comes down to ultimately. Do you want to talk about that issue, or do you want to push it back as long as you can? And I think central bankers, for understandable reason, because they've been missing that target for so long, don't want to talk about this now.
Does that mean in our analysis we can't aggregate, and that each society, each nation has to disaggregate into the haves and the have-nots?
So there are two aspects here. First, it doesn't make sense for so many countries to follow the same inflation target. It's as if I declare to everybody in this building, you should have the same weight target. We are different.
Why are you looking at me?
These countries differ fundamentally in their structure.
You see the Egyptian humor there?
What's Mohammed started now?
It's just,
seriously, Mohammed, carry on if you can.
I thought beige was slimming.
But the second issue, you and John, there's something about your beige suit that John wants to pick on, but I'm not going there.
Mohammed, I haven't said anything about the beige suit all morning. I haven't said anything.
I know, that's royalty.
Thank you.
And it's the
Am
summer.
I pulling it off?
And you said earlier, we're deep into the summer. Some of us aren't deep into the summer.
Did you see he made with the rent increases in London? His Royal Highness has had a $34 million pop in his real estate properties. Did you see that?
You should come to the UK if you want to see what inflation is really like.
We're going to rip up. We're going to stop the show right now. This is very cool. You're doing all your fancy finance stuff. You go over and put a shingle out at a university, and the Queen, Her Majesty, showed up to greet you at Queen's College. What was that like?
It was incredible. We were honored to have her as our patroness, and she was absolutely wonderful.
You mentioned if you want to experience inflation, go to the UK. Describe it for people. What's it like right now in the UK?
So food inflation at 17%. Labor, understandably, pushing back hard. So right now, the senior doctors are on strike. We've had a tube strike called off. We've had train strikes. We've had nurses strikes. We've had teacher strikes. You feel the real wage resistance, and you feel the government and the Bank of England torn between, on the one hand, accommodating the price-wage spiral, which they don't want to do, and on the other hand, understanding the distributional impact of what has been a huge inflation shock.
So we can't just have a different inflation target for a different country every year. That's going to be chaos. But based on the structure of the UK economy right now and the way you see the United States, what would those inflation targets look like? If you could change them right now, if Mohammed had all the power and you wrote down those targets now, what would they be?
So first of all, no one ever talks about changing an inflation target every year. That would be absurd. You might as well not have one.
Sure.
But the question is, if you look forward for the next 5 to 10 years, where's the right inflation target? And I suspect that the right inflation target is much nearer to 3% than it is to 2%. Now, that may not sound like a big difference, but it actually is a big difference over time.
In the States, and what about the UK?
And in the UK as well. Europe is the only one where 2% still makes sense. And Japan, which is an interesting one that we don't talk about enough because they have a major exit coming up, which they are denying for now, the exit from yield curve control. There, it's probably also 2%.
So and Gentilini talked about this, the former Italian prime minister in Europe as well. I'm going to keep Europe away from it right now because I think our audience really wants to understand your debate on R-Start. John Williams reframes to a lower R-Start. Ian Lingen of BMO Capital Markets agrees with that. Others agree with that we're going to step at us. I'm hearing from you, you brilliantly called higher interest rates to come. Do you see an R-Star that sets above where President Williams is, or can it even be higher? Rogoff suggesting even out to a higher new set for R-Star.
Yeah, I mean, it's a fascinating debate if you're an economist. You mentioned Ken Rogoff, I'd mentioned Larry Summers, I'd mentioned Olivier Blanchard. Yeah. I mean, a very active debate among people who basically come from the same camp. And they're having this debate. I'm more on the R-Star is higher than it has been in the past. So more on the Ken Rogoff, Larry Summers end of the debate.
I mean, I look at it as you spend too much time out in California and you may actually understand other factors, as Professor Blanchard talks about. This is not some neat economic surveillance babble, folks. There's a lot of other factors here, and one of them is a technological impulse over 5-10 years. Do we completely underestimate technology as how it overlays on our financial system?
So here we could have a 5-hour discussion.
We're doing that. You're here till 11 a.m., okay?
Think of technology that we're going through, the innovations doing the following. If you think of whatever distribution you thought of future growth and future productivity, some of these technological innovations in science, in AI, move the distribution to the right, that's good, but fatten the tails enormously. And it is how do you manage those fatter tails that is coming in this discussion.
I wanted to pick up on something you said earlier in the conversation, that there's a big difference between 2 and 3%. There's a lot of people listening thinking, what are you talking about? There's not much difference between 2 and 3% at all. Why is the difference so large?
Compounding makes a huge difference over time. And it's what you target to. My big worry, and you know this, is that if the Fed focuses on 2% in a relatively rapid time frame, we will end up in a recession. And I keep on repeating, you've heard me say this for the last year, there's no reason for the U.S. economy to fall into recession. The endogenous elements of this economy are strong enough to power through this period. So the big risk is that we follow the wrong inflation target and end up tipping this economy into recession. And it matters because you have the vulnerable segments of the population that have already seen their purchasing power eroded. Now you're going to add income and security to that. And that's not a good thing.
You know what's great here? I thought Ilarion showed up just to see us.
What's he here for if it's not to see us?
New Jersey. He's here for the sold-out Jets, pre-training summer camp.
Is that thing? I had no idea that was a thing.
He gets to pick up his Rodgers swag. Look at the summer hat, John, that he's going to pick up here.
The bucket hat.
The bucket. That's more than a bucket hat. That's like a Wimbledon hat.
Yeah, that is more than a bucket hat. What are they called?
That's like fancy. I couldn't afford that. It's fancy, It's got
so tell me, Tom, do you buy into this is the season the Jets make it to the playoffs, deep into the playoffs?
I say they make it in deep to the playoffs because we underestimated Namath when he showed up. And, Aaron Rodgers going to get a second, life here and all that. I'm actually pretty constructive on it.
You're a Jets fan this year. Is that on the record?
No, I don't want to go that far. I'm a Tots fan. I mean, it's enough pain.
Different sport.
But, do you have a Jets bow tie?
No, I do not have it. Don't you dare. Don't you.
Should make that
I got
happen.
an Atlanta Braves
that
bow
happen.
tie I got to wear.
Now I know what I'm going to get you.
Oh, you're killing me.
Is the Arsenal CEO going to bring us any merch?
I hope so.
We'll find out in a moment.
Hey, I was on with Neil Millington at the Lanesboro Hotel, and he's just, Tom, this is a once-in-a-lifetime opportunity.
Mohammed's going to stick with us, I'm pleased to say. If you're just tuning in, welcome to the program. Your equity market right now, positive by 0.27% on the S&P 500. In the bond market, yields just about unchanged, 384.28 on a US 10-year. Lots of big moves in the FX market. Mohammed Al-Aaron sticking with us through the next 30 minutes or so. Tom, we need to talk about reaction function, not just the data. And I think this is what Mohammed is getting at. His former colleagues over at PIMCO are talking about accepting, tolerating 2 point something. 2 point something. And maybe 2 point something is very different to trying to get inflation down from 3, 4, all the way back down to 2.
I would talk about the real and the nominal space, and a lot of this theory is based off inflation-adjusted dynamics, reaction functions, even, dare I say, differential equations, and that the corporations don't matter. I don't even think the public matters. The public lives in a nominal space, what the British call a money space. If you take a course with Al-Aaron, he's got the chalk in his hand at Cambridge, and they're all dusting it up. They don't say nominal, they say money space.
Did I throw?
Yes. Is it a once and done on the UPS thing, or is it something more? General.
We're talking about strikes.
Yeah.
Oh, there's more to come, surely.
Call. I think it's a tough call in America. It's not Europe, is how I look at it.
The strike stuff is, the threat of strikes is not over.
Oh, yeah. I mean, it's there, but I'm not sure it's they want to make it a euro equivalent, and I'm not sure it is.
We've got a break, guys. Got to go. Equities up. Good morning.
Aaron Rodgers.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think we're going to see some deflationary pressure, so that's going to kick in, I think, into the fall. Right now, it's all about earnings. So far, I think they'll come in fine. If we are going to get some sort of a soft landing or some sort of period that's not imminent recession, I think those laggards have to be bought.
Great range of guests this week on the market. Peter Cheer there, Academy Securities Head of Macro Strategy, live from New York City this morning. Good morning. Your equity market shaping up as follows on the S&P 500. Positive on the session, up on a week on the S&P by a third of 1%. Into the bond market, Treasuries rallying just a touch here, TK. Yields lower by a single basis point. On the 10-year, 383.69.
This is a joy as we talked yesterday to Daniel Ricciardo and all that he will do at Budapest this weekend in F1. We continue the debate forward on Premier League in America. And what is important wrapped around the surveillance table here are three other people way smarter than me on Premier League. I will state the following. The sum total of my Arsenal knowledge is from the glorious Neil Millington at the Lanesborough Hotel, where the entire staff, I walk in with Mrs. Keane, she's got a Tottenham hat on, and we were treated like, only the Lanesborough. It worked out great. They treated us like royalty here. But good morning to Neil Millington. I'm going to put the surveillance cork in my mouth as we talk the great success last year.
I can't believe we've got a Tottenham fan sitting opposite the Arsenal CEO. Vinay Venkateswaran joins us now. Vinay, great to see you, sir. Big game tomorrow against Manchester United at MetLife Stadium. Before we get to all of that, let's just start with why here? I see a lot of Spanish clubs come to the United States now. A lot of Italian teams do their pre-season tour here. Why is this so important for Arsenal Football Club?
Sure. Well, firstly, thank you for having me on the show today. The US has become our #1 international market. And we see that anecdotally. Every time we come to the US, we come every couple of years, we can see the games growing and we can see Arsenal's popularities growing. And we also see it in the numbers. So last season with NBC Sports, we had the record audience for Arsenal Manchester United. We see our social media following growing really fast. 20% of our retail business is in the US. And we played the MLS All-Star game in Washington, jam-packed full, and jam-packed full of Arsenal fans, which was great to see.
Great to see. Lots of money in it, I'm sure. You're also spending lots of cash as well. And I'm sure a lot of Arsenal fans want us to go straight there. How much have you spent this summer on football talent?
Well, so I guess the story about this summer really starts with looking back at last season. So last season we had what we consider to be a successful season. We took the title race right until the last weeks. In the end, we finished second rather than the first that we were fighting for. But we have one of the youngest squads in the Premier League. So this season, they're going to be another year more experienced. And what we've done this summer is supplement that fantastic squad with 3 new signings, the 3 positions we wanted to strengthen, the 3 players we wanted. And we were delighted to get them right at the start of the window. So we have them here with us on tour in the US, and it means they can assimilate in the squad. And it was a heavy, significant investment. And that investment really shows the ambition of our ownership group. They have had an enormous success with their franchises in the US over recent years, winning the Super Bowl, winning the Stanley Cup, and then winning the NBA Championship. So they've really invested behind the team and have really supported us this window. So we will be ready for the fight this season.
Thank you for making last season so interesting till the very end, and congratulations on your purchases. But let me put you in a tough spot, if I may.
Sure.
There's 2 views as to what model should major sports run. One is the UK model, where you don't have forced equalization, where you have relegation. One is the US model, where you don't have relegation, you have forced equalization. Mm-hmm. If you were to create the Premiership from scratch, would you keep the current model that allows a few teams to dominate all the time, or would you go to more like a US model that allows for far more equalization?
I'd keep the model that we have at the moment, and I think it's proven. The Premier League is the world's biggest league in the world's biggest sport, and I think one of the reasons the Premier League is so successful is the broadcast distribution in the Premier League is actually relatively equal. So the top club in the Premier League gets roughly 1.8 times the bottom club in the Premier League. So we try and keep the revenue distribution as equal as we can to make sure the league is as competitive as it can be. And it goes in cycles. Sometimes you have a period where teams dominate, and sometimes you have a cycle where it's more competitive.
I'm rooting for Sheffield United.
Sheffield this year?
Sheffield United. Me and Joe Elliott, destined.
So being a QPR supporter and just looking up to the Premiership, you'll understand how we feel about our inability to ever penetrate because of what happens above us. But let me ask a question. So you're seeing all this US support come to Arsenal, and I'm hearing there's a lot more interest in soccer, as they call it here, on there.
Yes, they do.
Is this a pull factor or push factor? Is this people being pulled by the fact that NBC is covering more games, or is it the fans that are pushing people to talk more about UK soccer, including Tom and John?
I think it's a little bit of both. I think NBC have done a fantastic job for the Premier League over a long period, both in terms of how they promote the game and how they've also educated the audience around all things football. And we see it in their viewership numbers. I think NBC's viewership numbers last season were 20% higher than the season before. We've got our game tomorrow at MetLife. It's going to be a sellout. It's going to be our biggest ever game from revenue perspective that we've ever played in the US. And I think it's going to be MetLife's biggest ever soccer game that they've had in their stadium as well from a revenue perspective. So the demand is really, really, really there, and it's growing really quickly.
Got to talk to you about Saudi involvement in the game, increasing through this summer, particularly over the last couple of years with that purchase of Newcastle more recently. What does it feel like as a CEO of a football club to be competing with a country? Not a single person, but a nation. What does that feel like? Do you feel like you're doing that now, this summer?
Well, the Premier League, one of the reasons the Premier League has been so successful is because it's so unbelievably competitive. And, you know, Newcastle are another team that are stepping forward in that competition. They had a very successful season last season. They're in the Champions League. So it's always a dynamically changing market. Another big change that everybody's been talking about this summer has been the number of players they've actually transferred to Saudi. So that's another interesting development in the game. It's new. It's a little bit too early to know how that's going to affect the Premier League, if at all, and we'll all be watching with interest.
Long ago in my youth, I saw the Rochester Lancers and a wonderful guy named Charlie Schiano try to make this happen. And the fact is it was perceived by me and everybody else in America is minor league football. What is the symbolism of Messi going to MLS now? Does he take them from minor league football to something new and different?
Well, the MLS has been on, as I understand it, a good growth trajectory over many years. The league's expanded. There's been a number of expansion franchises. For us at Arsenal, we want football, or soccer as we may call it here, to grow in popularity. So we want there to be a vibrant, healthy domestic league in the MLS. Messi is a generational talent. So have him in MLS playing in Miami, I think will have a really, really positive effect. At the same time, the new Apple TV deal is going live as well. So we're really hopeful that will help continue to grow MLS. And we've seen in the few days we've been here how much coverage there has been around Messi and how many people have been talking to us about Messi. And that's what we want. We want that conversation to be going on.
Do you think Harry Kane could come to MLS?
I'm sure that Vinay would like Harry Kane to get out of the Premier League, to be honest with you.
Just
I won't ask him directly about that.
I'm trying to show my deep knowledge.
The Apple deal, Vinay, I've got 45 seconds, but I want to squeeze this in. The Apple deal's huge. For a football player to get a slice of the TV money directly like that, do you see more of that happening?
Well, listen, I don't know the details of the Messi deal, so I just read what everybody else reads. But listen, I think Messi, all I can really say is I think Messi can have a really, really significant impact on the game. And I'm sure here in this country, and I'm sure it was a really competitive process to get him to play here, because there's lots of people that would love Messi playing in their league. And I'm sure MLS had to work really hard and really creatively to get here. And they've been successful because he's here and he's driving a whole lot of interest.
The Saudis were one of those, weren't they, trying to drag him over. Vinay, this was great. Let's do this again. Good luck tomorrow.
September 24.
What's that?
So ask them.
North London
September
Derby.
24.
We're trying to get tickets.
September
I was going to do that in a commercial break,
Okay,
TK.
sorry.
But, you know, we'll do that a little bit more.
Only September 24th.
Every time I come to the Emirates, we win, all right? You know.
Oh, well, okay, well, now you're talking. Now you're talking.
Vinay, thank you. This was great. Thank you, buddy, and good luck for tomorrow.
Thank you very much.
Equities right now on the S&P 500, just about positive. Mohammed's going to be sticking with us. RJ Gallo of Federated Hermes on this equity market. Coming up next, going into a massive week for central bank decisions, tech earnings, and a little bit of sport as well this weekend before we get there.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Equities on the S&P 500 positive by 0.4%, a lift in the equity market on the session on the week. Down yesterday, down hard on the Nasdaq. That's rare, considering what we've seen so far this year from the Nasdaq 100. Worst day for the Nasdaq, going back to February off the back of a pretty weak day for the likes of Netflix. Worst day of the year for them in yesterday's session following earnings. Tesla, worst day since April. Bit of a lift this morning across the board for the Russell, the small caps as well. In a bond market, 2-year, 10-year, 30-year. Let's slice and dice the Treasury yield curve for you. Yields are coming in 2 or 3 basis points on a 10-year to 3.82 on a 2-year, just about unchanged at 4.8351. That puts the 2-10 spread at negative 101 this morning. We've just been in and around that level, TK, over the last couple of days.
That's still serious inversion. David Rosenberg nailed this. He said, look, you can do this, interpret it all you want. The fact is the market is pricing out significant inversions, plural, looking at different spread markets.
The Fed's at 5, and that's not been pushed through the curve that aggressively that far, because there is this belief the Fed's not going to be there for too long.
The ramification, negative 101 basis points, a percentage point difference between the 2-year and the 10-year, for that to go out and breach through 111 would be unexpected, to say the least. We've got such a good Friday going on here. Yeah, lots of distractions, Arsenal football, Barbie, and all the rest of it. Let us look now at a sterling conversation on the rate market. We can do that with Mohammed El-Arian joining us here from the University of Cambridge, a nodding acquaintance with a bond house out on the West Coast a few years ago. And joining us as well, someone managing real money and strategy, RJ Gallo, Senior Vice President, Federated Hermes, as well. RJ, the disinflation battle, Michael Gapin at Bank of America has got a great chart where we continue with a disinflation, we go level, or dare I say, we revert at some point to some lesser disinflation. Which way do you perceive inflation will move?
We've felt for quite a while that the inflation that we have been through over the last 12, 16 months was heavily fueled by post-pandemic distortions, and ultimately the Fed, I think, believed that as well. That those were healed. The New York Fed has a good supply chain barometer that they developed during the pandemic, which went from 4 standard deviations, kinked or tight or messed up, and is now 1 standard deviation to the favorable side. Right. That has a lot to do with why we think the disinflation we've experienced has taken place. The tougher part now will be getting these core numbers back down to a level with a 2 handle that'll keep the Fed relatively pleased. So we're optimistic we're in the right direction, but the tougher sledding is probably ahead of us.
And this is absolutely brilliant, Dr. O'Leary, this is why I'm so thrilled you're here. When we say standard deviation, we're really talking about a study of the cross moments and particularly variance of the moment. Is our financial system and investment system so screwed up now, we can't use a traditional standard deviation analysis?
I would say our financial system is distorted so that history in terms of analyses is no longer what it is. But the other thing which we have to acknowledge and it's wonderful that we have RJ there because he's in those markets, is despite this enormous volatility in fixed income. Just think of the journey of the 2-year between 511 to 350. Nothing has broken. So the resilience of the system has been really impressive, and it will be interesting to get RJ's reaction to that. How is it that the system has been able to resist these incredible volatilities and nothing has broken in the system so far?
Well, it makes you wonder if the regulatory rework that followed the global financial crisis might have struck a few of the right chords. More capital, more liquidity certainly helped. I would note, however, that back in the spring when I hadn't heard of Silicon Valley Bank. It's not big in the markets in which I travel, but I certainly heard of them in March. The stresses that emerged from the rapid repricing higher in yields and the big duration-related losses on the left-hand side of their balance sheets, that put stress on the banking system. What I think is particularly interesting is how we didn't have an ease. The track record of the Fed is you tighten until something is strained or breaks, and then ultimately you have to ease. And what we saw instead was a Fed that wanted to keep rates high. In fact, they have gone higher. And they layered in various mechanisms working with other banking regulators in the U.S. and abroad to relieve the liquidity challenges that had emerged from their drastic tightening on regional bank balance sheets. So stress has occurred, but the system is holding up. So I would agree with you, Mohammed. It's a favorable development if you can battle inflation without blowing up your system.
I think, RJ, people are less surprised about the bank's resilience, and they're more surprised about the non-bank financial institutions. How is it that a whole sector that got used to floored interest rates, massive and predictable injections of liquidity, how is it that that whole sector, which has lots of leverage elements to it, how is it that it has navigated so well the change in interest rate and liquidity regimes?
It's an excellent question. Perhaps the transparency has helped. This is only the second tightening in the Federal Reserve's history when we had the dot plot, when we had the policymakers giving us a projection, not a promise, obviously the dots moved, but a projection of where they expected rates would go. That type of forward-looking indication by those who are making the policy should be heeded to at least some degree by those who are making investment decisions, but managing risk in the marketplace. I would think that likely helped to communicate. Eventually, the Fed abandoned transitory and had to take rates, it's like on a rocket ride, straight up, pretty much. But they did communicate that, fairly clearly once they got away from the transitory fiction. And I think that forward-looking transparency likely helps the highly levered marketplace, including the non-bank institutions, to adjust to what has been a volatile and challenging time.
I can hear people at home screaming one word: wait, wait. Mohammed, what evidence is there that these high rates, this tightening cycle worldwide, ECB, BOE, Federal Reserve, has started to bite yet?
Well, it depends, started to bite where, right? As RJ correctly said, it did bite in the regionals. It hasn't bitten in parts of the economy that you would normally expect it to bite. But most importantly, John, and I think that's where you're going, it hasn't bitten in commercial real estate as much as you would expect it. But wait is what people are saying, because these things refinance over time. And whether it is the commercial real estate markets or some other highly levered, the next 6 to 12 months are going to be really interesting, because you have certain activities that were funded in a completely different world that make no sense today. So either they will be able to be refinanced because there's massive balance sheet resilience, or they're going to have to be repriced violently, much more violently than what we've seen so far.
RJ Gallo, Dr. Larian and others talk about a larger picture, a bigger macroeconomic view. You've got to deal with the reality of a portfolio net clean to the client. And what that comes down to is diversification, less diversification, more diversification. Is there value in diversification now, or do you want to be focused and take your bets?
Well, Federated Hermes very much is on the active management side of the industry, so we do believe in taking our bets, but we do so responsibly, focusing a lot on risk management, looking at the volatility that we model into a portfolio as we consider changing our weights. Currently, it is still a risky world. I think, as Mohammed just mentioned, this fight isn't over yet, and the echoes and the ramifications of the Fed's action, some of that remains to be seen. I think as commercial real estate reprices sharply lower, we're likely to go through periods that will result in asset loss in the banking system and elsewhere, hopefully not to liquidity crises, but asset devaluations. That's one of the reasons why we are still sort of bearish on the view. Right now, the soft landing narrative has really taken off in the market. We still think a mild recession is in the offing. It's going to come in the next 3 to 9 or 12 months. And as a result, we're up in quality in our diversified portfolios. But even though we still have significant weightings in high yield and investment grade just below index. That's part of what the diversification and responsible management is all about. You don't bet the ranch on one trade.
Mohammed, I just had a wonderful and lengthy conversation, a generous conversation with Nassim Taleb. And we, of course, discussed the tails and, the tail risks and Gaussian versus Poisson and the rest of it as well. Do we have visibility on what our risk tails are right now? Or is it just a complete mystery post-pandemic?
So I think Nassim would have said we have some visibility, but not a lot of visibility. I mean,
This goes back to your phrase, you codified unknown unknowns. Is that where we are?
Yeah, I think we're living in a distribution of outcomes that is different from the past in two ways. One, the tails are much fatter. Two, it's multimodal. We could actually settle at different equilibria, and we're not quite sure which equilibrium we're going to set in. That's why there's this whole discussion of soft landing versus hard landing. This is hard. I look at RJ, I look at my friends and colleagues at PIMCO. This is a very hard market to navigate. You can be tactically confident about your view, and right now, as I've shared with John, you should be tactically bullish. But secularly and strategically, it's really hard.
Okay, but let's go to Imperial College where they really do math, unlike at Cambridge. So if you're with Paul Wilmot and Kent Osmond and all those over there, does binomial analysis of risk right now work?
It doesn't work because we don't have enough historical observations. So this is really hard. It's really, really, and that is why you'll find the marketplace goes back to what is familiar immediately. That's been the tendency over the last few years, is that you can't have clarity going forward, so you become very short-term, including the Fed. This excessive data dependency of the Fed is an unwillingness or inability to take a strategic view of the economy.
Let's finish there. And I think everyone is feeling the same way. What regime are we in? I don't think anyone's really got a clue. That tactical call that you presented to us last week, you said this soft landing narrative is hard to fight. Just get the feeling from everyone we speak to on this program that they seem to believe this sweet spot is for the summer. That confuses me, because if we all know the same thing, then what's the edge to that? I'm trying to work out what's going to happen in September and beyond. Shouldn't at some point that kick in, the uncertainty about what happens next?
It should, but greed is a very powerful factor, and short-term performance comparisons tend to make you look short-term. I think most people feel comfortable right now that for the next few weeks, I didn't say months, the next few weeks, we are in a soft spot. The inflation numbers are going to be accommodating. We don't expect any major disruption from the jobs report. And up to Jackson Hole, people see clarity. And as long as you see this clarity, it's going to bring more money in. I mean, just look what's happening to the market today. We're bouncing back.
Equities right now bouncing back by 0.4% on the S&P.
RJ Gallo's lifting the equity market.
RJ's got to go, Tom. RJ Gallo of Federated Hermes. RJ, thank you. Mohammed, this was great.
Thank you for having me.
It's good to see you. Just fantastic, as always. If you are just tuning into the program, welcome to the program. Your equity market positive on the S&P 500 by 0.4%. Coming up in the next hour, we'll catch up with Elise Ossenbar of JP Morgan, Andrew Balls of PIMCO, Keith Lerner of True East, with some of your colleagues there. Mohammed, from back in the day, Andrew Balls, they're really
wonderful.
They're going to this tolerating 2-point-something at the Federal Reserve. Does that resonate with you, this idea that the chairman at the Fed just tolerates 2-point-something?
I think that's what he'll end up having to do, yes. And I think Pimco got that completely right.
And to your point earlier, and this is Andrew Ball's wheelhouse too, it's the new politics of the ECB. I mean, I'm getting this sense that there is a crack in the ancient inflation worry of Europe, and all my radar's up on that, because how many times have we been wrong on that?
When you hear an ECB hawk, like we did this week, remain uncommitted to what happens after July.
Right.
I think, Mohammed, there was some signal in that this week, don't you? The fact that the ECB You know, that's a hawk. If that's the hawk on the governing council, what do the doves think about what we should do next?
Well, we know what the dove think.
Stop.
John, I wasn't planning on doing this Arsenal Man U thing, but you know, Mike
going to the game?
emails. Well, all of a sudden, I get the Blade helicopter off of 30th Street for $850 to go out like, what is it, 1 mile out to MetLife?
Is that how much it costs to get that helicopter
$850, yeah.
over to New Jersey?
I mean, all of a sudden, it's possible.
Have you got tickets for that?
No, I don't have tickets.
Okay,
just,
so we
you know,
don't have movie tickets.
No, but the guy from
We don't
Arsenal
have-
let us in.
Okay, I'm not sure he can let us in. He's not in control of the stadium.
What's a friendly? What do they do? What
These
in
games.
God's name is a friendly?
These games.
I mean, seriously. Does Declan show up? Like, do the stars, are they there?
Yeah. No,
They show up. Are they committed?
And they play.
They're like playing spring
A
training.
friendly means it doesn't impact their professional position in terms of either the league or anything like that.
It's like
gonna
me
play
every
hard?
day. Every day for me is a friendly.
Are they going to risk injury? No. Equities are up. From New York City. Mohammed, thank you again. This was great. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The last inflation print was quite low, and we're kind of on a bit of an easing trend on inflation, and the Fed is, seems comfortable hiking slower or being completely done. Most people had this, recession in their forecast and fear that the Fed may have over-tightened. As that recession risk gets pushed out and maybe even minimized, people are starting to get a little more confident and comfortable owning that cyclical part of the market.
Stuart Kaiser, really quite good on the equity market yesterday. We're going to continue that discussion here. David Bianco's with us right now, CIO, DWS Group, and also Mohammed El-Arian has agreed to stay here. He's looking at that helicopter out to Arsenal and Man U and saying, I can say another block. I got to get those tickets in before we go out to the friendly. Anthony Dominic Benedetto has died. He's 96 years old. The last time I saw Anthony Dominic Benedetto, was in a coffee line over in Central Park South, and he was wonderful with a little girl of 6 years old. That was the heritage of Tony Bennett. He's someone who went on in his older age to wonderful paintings and activity around Central Park and New York. The last time I saw him was at a party for Andy Lack. This is 5, 6, 8 years ago, can't remember. And here he is on an afternoon, folks, showing up with a bunch of industry bigwigs, and he could have mailed it in. He did not mail it in, and I would suggest Tony Bennett just simply did not mail it in for his entire life. He is dead at 96. What a life. What an American. Right now, we continue. David Bianco with us and Mohamed El-Arian. We talked bonds here. In our last discussion with David Bianco, we're going to talk the challenges of this market. What do you say to people, David Bianco, that missed this equity market?
Wait. You'll still have an opportunity to bite at this apple. Of course, the equity market's really been largely driven by the tech stocks and the digital stocks. And there's some good reasons for why that's occurred. But you have to understand, especially when you invest in growth stocks, it's about the future and taking a view on how demanding the valuations are for what's expected of these companies. And we have not seen valuations this demanding since the late 1990s.
My cardinal rule is equity strategy, equity thinking always is wrapped around, say, the economics of Ed Hyman. It's wrapped around the bond markets that you lived and breathed with Bill Gross at PIMCO. Do you suggest the bond market can lead and be a precursor to what we see in equities?
It tends to be, and I'm very curious by David's phrase, wait, the sentence wait. What are we waiting for?
Right. Well, there are a few things that I think will give us a better opportunity to buy tech stocks. And I'm also of the view that they're probably heading for a very long period of consolidation. So I think when you look at various asset classes, to be an equity investor, you have to know about interest rates. You have to know about the economy. You need to know about commodities and currencies. And each market is most sensitive to what it is most closely related to. And the U.S. economy and the labor market, inflation, the bond market's focused on that. But the equity market, being dominated by tech, is thinking about artificial intelligence, innovation, big growth surprises to the upside. And I would just simply say the equity market is asking a lot of these tech companies to solve the challenges facing us this decade.
That's fascinating. I love the way you characterize to be an equity investor, you need to understand all these other markets. That's not the traditional wisdom. The traditional wisdom is equity investors are very much bottom up. They focus on companies, and all these other markets are interesting. Once in a while, they influence them, but they don't really impose themselves on them.
Shade he's putting on us right
well, look, I'm a macro-minded investor.
Mohammed's correct.
And there's a lot of bottom-up thinking that's really crucial, especially for stock selection. But some of the best stock selectors, ones I work with at DWS, we've all been aware that in many cases, these are powerful macro trends that we've been facing, whether it be globalization, deglobalization, disinflation, inflation. What are normal interest rates? Something I think you've been thinking about quite a bit with other great bond investors for this decade. And that is an important part of what is a fair PE and trying to evaluate how demanding these valuations actually are.
Let me posit to both of you. I'll start with you, David Bianco. Right now, I think it's so important. There is a retail America addicted to either 7-stock, massive double-digit return, or even a blended 15, 18, 19% return, way off the Ibbotson actuarial assumption of 100 years. Describe fear of missing out and how it could possibly burn us down the decades road.
Well, the investors who've owned those great stocks, the 7, 8, 9, 10, whichever list you want to make, but there's a lot of common names that we list there. It's made a lot of retail investors rich. And the ones that work at these companies have founded these companies. It's going to be hard for those who've done so well to be shaken out of those positions. But I would simply say that doesn't mean that others are going to be joining it because I think the returns from here are meager.
So do you, Mohammed, if you go off Roger Ibbotson's work at Yale and the log extrapolation, I take it from the Guadalcanal low of 1942, the answer is why be in bonds if I can be in equities and over some long term I'm gonna succeed as well. With the death of Markowitz, the Nobel laureate, 95 years old, why do I need to do 60-40?
Well, and that is the big question. You need to do a 60-40 or a diversified portfolio, which I like characterizing as such, because risk management matters and because we know the behavioral mistakes that we make if we don't have some sort of inherent risk mitigation in our portfolio. But there is a fascinating issue. Is this about markets or is this about themes? So I could push it back to the both of you and say it's not usual for us to have two sets of stocks, one that are riding a massive secular wave, AI being one of them, and two, these all-weather stocks, the ones that seem immune to most of the macroeconomic developments. And we're thinking here of big tech. of a few names that we both know. So I understand why the retail investor has been so attracted to that. Not only, like David says correctly, they've made money, but the theme investing is very powerful right now.
Within this glorious hour with Dr. O'Leary and David, you've really added a lot to this. One of my great mentors in England is it's a small school in London, you may know it, London School of Economics, Meghdad Desai. And Lord Desai codified the importance of profitability.
Of course.
Describe how profitability will work out over the next 12 months.
Well, obviously, that's the mother's milk of stocks, growing earnings. But let's just look at what we're confronted with right now. We still expect a small recession. And really, the more important thing to emphasize is a very small recovery, shallow recovery. And we're in an environment where the disinflation you see is happening at goods, which is largely what public companies, the S&P 500, make, and we're seeing follow-up inflation on services and labor. So I think in the short term, you've got some profit. We have not had earnings growth at the S&P for the past 2 years, quarterly, sequentially. That will happen this quarter and will continue for a few more quarters. And then I look at the decade, and I think it'll be a more challenged decade for the typical companies at the S&P to grow their profits. And I think we're heading to old norms of interest rates, which will challenge the PEs.
Got one final question here for Dr. O'Leary, and a tour de force. Bloomberg reports today, folks, I'll get it out, John Authors and Isabel Lee, it is an absolute tour de force on never have we seen the strategists so divided, never have we seen them as a general statement so wrong. Beautifully laid out without any malicious, no snark, anything like that. What do you say to our pros watching, our strategists here, as they look into the crystal ball out the next 12 months?
I go back to Ben Bernanke's phrase, unusually uncertain. That's the world in which we're operating. There are major secular shifts going on, and it is very difficult to get visibility. We go back to what the distribution looks like. This is not a normal distribution. This is not a distribution that has one dominant expected outcome and thin tails. And that is what David and others are navigating through, and it's not easy to.
One day at PIMCO, you and Bill Gross honored me by having me come into your triple top secret 10 a.m. meeting. What's it like having Tony Crescenzi in that meeting? I mean, what does he just take over and start talking short-term paper?
So the great thing about that meeting is that you have lots of really smart people who are in there just to try to get to the right answer. And this investment committee that continues under Dan Iverson is a very powerful mechanism for getting a whole diversity of views, from Tony to others.
Yeah. Thank you so much for coming in today.
Thank you for having me.
David Bianco, thank you for having us close strong in this hour. Extraordinary Friday here. This is what a summer Friday ought to be like, where I'm forced to wear a pink tie for Barbie and I'm surrounded by...
And the shoes, Tom, and the shoes.
Oh, the shoes are here too. I don't know. You want to come over, you can look at the... Look at the shoes. It's a frightening thing as well. This is, I don't know if we get on radio, these may be too much. People drive off the Garden State Parkway. Thank you to our team, and particularly for having us talk to Arsenal ownership today as they face Manchester United at MetLife. Futures up 21, a nice lift to the market off the carnage yesterday. The VIX under 14 is the David Bianco VIX, 13.74. Please stay with us through the day on radio and television. This is Bloomberg.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance. Caroline.
To attend unique networking events. Good luck, and we hope to see you there.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not
experience with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's wrap up the trading week. Live from New York City this morning. Good morning, good morning. Your equity market bouncing back. The S&P 500 up 0.5%. The Nasdaq up by 0.7. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, tech earnings disrupt the Nasdaq's big rally. Strong US data putting a Fed pause on ice as the BOJ remains committed to easy money. We begin with the big issue, a summer sweet spot.
Now we're in the sweet spot.
The bears are like melting in the hot summer sun. Strength in the fundamentals really helps spur this risk-on rally.
Growth is held up very well.
You've had massive positive growth surprises.
It's really a celebration of disinflation.
Inflation's coming down.
The Fed is, seems comfortable hiking slower.
The prospect of a recession has trended lower.
Maybe we won't have that recession. It's status quo for now. It's right to think about sort of what comes next.
We're a few percent overvalued.
The risk is that inflation kind of goes back up.
September, October are treacherous months for the markets.
We're not out of the woods by a long shot.
Let's have that conversation right now with the brilliant PIMCO's Andrew Balls. Andrew, wonderful to catch up, sir, as always. Investors worldwide at the moment seem to be embracing the idea of a soft landing. Do you and the team still see a recession stateside?
So we think the most likely outcome is a recession, but there has been promising signs in the data. So you could certainly have a slowdown, but without the formal recession. I mean, the interesting thing is we think that you're going to have to see slower growth and some greater weakness in terms of the labor market in order to get inflation coming down next year. Towards the Fed target. So still our expectation of the rise in unemployment and the kind of magnitude which would normally be associated with having a recession, yeah.
We seem to be in this sweet spot at the moment where inflationary trends start to look disinflationary, where unemployment remains low at 3.5%, payrolls growth remains decent. Do you think that sweet spot can last beyond the next couple of months?
I mean, I think yes. I mean, I think the decline in terms of inflation is promising in the US. Hopefully, it's leading indicator for Europe, where we're a little bit behind. But there's not a lot of indication yet of greater labour market weakness. But we do think you have the lagged impact over the next few quarters of all the tightening we've seen, and it's been very, very rapid rate cycle from the Fed. We think that the impact of tighter credit conditions from the regional banks in the US play into this as well. So yeah, more likely than not that you have a recession over the next few quarters.
Let's turn to the Federal Reserve. In your secular outlook in the last couple of months, Andrew, you and the team mentioned that this Fed would tolerate 2 point something. Can you tell me the difference between 2 and 2 point something? How big is that difference?
So I think, and it's something that my colleague Rich Clarida has talked about a lot, for the Fed to think about easing policy rates over the next year and a half, they're going to need to see inflation coming down from where we are now. And once you get to 2 point something, I mean, at that point you can start to think about rate cuts over time. And there's a question, an uncertainty about quite how the time frame for getting from 3 something down towards 2.0, and this may be something where the Fed is willing to be a little bit patient. But once you get down below 3%, that's near enough, we think, for the central bank that they'll be then thinking about the other side of the dual mandate as well. This recent period, clearly the focus has been wholly on inflation, just given where we have been.
Are you making the argument, and Andrew, that maybe the window for cutting might be closer than people anticipate?
I don't have any big disagreement with the way the market's pricing. I think the time frame for next year looks reasonable. I think there's two big sets of risks around the baseline outlook. One is inflation stickiness. The other one on the other side is greater than expected weakness in the economy. And I think over time, as you get more confidence in terms of the inflation outlook, including getting below 3%, then clearly the focus for the Fed, I think also the focus for markets will be more on the growth risks to the equation. So I don't have any particular disagreement with the way that the market is pricing now. But as you get more data, if you do get better indications on the inflation side, then I think the growth risks will come to be clearer in focus.
Can we push that through the bond market currently with a 10-year at 382? Are you and the team saying that's a buy here?
So I think that the level of yields looks pretty attractive for the next few years. I think the outlook in terms of returns looks very attractive for high quality bonds, and if you look at the yields you're getting on high quality bond funds, and then compare that to expected equity market returns, and I think it looks very attractive. And then the second thing is, with policy rates at these levels, we've just been talking about the potential for Fed rate cuts over time. You do have that real room for policy easing, and that room for bond portfolios to provide a diversification versus equities in your overall asset allocation. So I think the level of yields in the US looks attractive. At PIMCO, we've been generally adding a bit more duration in our portfolios over time.
Andrew, where does that leave the shape of the yield curve? Because currently the 2-year versus 10-year is negative 101. That's deeply inverted on a historical basis. How are you anticipating that's going to evolve in the months and quarters ahead of us, given what you anticipate is going to happen with growth?
Yeah, so I think it's been a long period of inversion off the back of this inflation shock. We've had this policy rate shock. I think over time, and if you look into into forward rates, you see the normalization of the curve over time as the Fed is able to cut rates over time. So in our portfolios, over time, I think we will have a bias to have curve steepening positions in the portfolios, but I don't think there's any great rush to put that on myself, because we very clear indication that the Federal Reserve will hike rates next week, and they may well go again after that.
So that's the Treasury market and the prospect of a downturn in economic growth. We need to turn to credit as well. High yield spreads, Andrew, are so tight. Near the tights of the year currently at about 380 basis points. I just wonder whether you're anticipating a pickup in defaults, if you're looking for a downturn in growth, and how you'd be positioned in credit currently.
So back to the kind of the outlook, the baseline of the possibility of a soft landing, probably more likely a shallow recession. I don't think that has to be too problematic for credit in that baseline if we get there. The problem is the risk cases around this. If there's inflation stickiness, if the Fed is forced to go more, I think that could be quite disruptive for risk assets and high yield. And in a downside growth case, if the impact of the Fed tightening is more than we markets, PIMCO, or the consensus is pricing in, I think that's problematic for credit as well. So given the tightness of credit, I think it makes sense to be a little bit underweight here. And there's other alternatives. There's other ways of earning spread without that exposure to corporate credit. I think agency mortgages look quite attractive in the US, and I think more broadly there's a set of mortgage-related securities you can buy in the US and globally that look attractive. So I think that's offering better risk reward at the moment compared with corporate credit. And then back to the level of 10-year yields for treasuries and the yields on high quality bond portfolios. I think sticking with IG, sticking with investment grade credit, seems perfectly sensible here. You don't need to go down in quality or liquidity, I'd say, because the yields you can get with high quality bonds now are really, really quite attractive.
The focus, as you know, this morning, not just on the Fed next week, not just on the ECB, but also on the BOJ. We're reporting that the BOJ isn't going to move away from yield curve control anytime soon. Andrew, if we did get a reset of policy at the BOJ, and forgive me for the what if, but I am trying to work out what the scenario analysis might be from a place like PIMCO. If you back away at the BOJ, how are you thinking that spills over the European bond market, spills into treasuries? Is it just a wholesale drop of bonds abroad and Japanese investors return home? Like, what happens if the BOJ backs off?
So I think there's a range of outcomes. If you want to start an argument at PIMCO, this is a pretty good topic. So there's some of us, and I would be in this camp, that think that the BOJ move is very well telegraphed over time. It's expected that they will move away from yield curve control over time. And compared with the rate shocks we've seen in terms of the Federal Reserve, the European Central Bank, et cetera, it's hard to see why this should be such a big impact in terms of global markets. There's another camp, though, and this is often people who are working on the hedge fund side of the equation, where real sensitivity to spillover effects from the BOJ move. So I think we'll see how this plays out over time. My view, and if you look at the move in December, when they started this process, there were no big impacts in terms of global financial markets. So my expectation is something that's well expected, should not have too big an impact. And then with JGBs, I mean, we are probably at a somewhat artificial level here. You would expect yields to be a bit higher. You see this with the swap market if they were to move away from YCC. But I don't think we'd expect very, very significant moves. And yes, as a Japanese investor, when you're based in yen in particular, I think over time you'll want to see Japanese institutions owning more, being a bit closer to home. But again, the interest rate shock we've seen, the levels of yields available, say on European assets, I think for the market to absorb any shift from the Japanese investor base away from Europe, say, I don't imagine this would be something that would be too difficult to be absorbed.
Andrew Balls, thank you, sir, for the outlook on the Fed, on fixed income, the BOJ at the end there too, the PIMCO Global Fixed Income CIO. Triple header next week, BOJ, ECB, Federal Reserve, all coming up. Let's get to Mike McKee on that. Morning, Mike.
Good morning, John. Well, call those the three faces of risk, maybe, because it's not going to be what the central banks decide that moves markets. It's what those leaders are going to say about their future policy. Take a look at what's expected. You've got a 95% chance of a Fed rate move, a 96% chance of an ECB move, and less than a 10% chance of a Japanese move, even though we have the Bloomberg story out today suggesting they'll talk about yield curve control. Look at the September numbers. Much lower, and in Japan there's actually a negative chance for a rate move. Here's why. The economies in these countries are cooperating with their central banks for the most part. We have new surveys out of economists across the world, and in the CPI inflation area, it's progress. Everywhere you look, quarter by quarter, inflation is expected to drop. Now, that's a problem for Japan, which may keep them sidelined longer, but for the United States and the Eurozone, it is what the Fed and ECB want to see. Unemployment also seen as moving in the directions that the banks don't necessarily want, but they've predicted higher in the United States, higher in the Eurozone, but no change in Japan. So Japan likely sidelined, but the real questions for investors are what comes next. As I mentioned, the Fed, they want to clarify the outlook. The ECB, convince the markets there's no cuts ahead, and the Japanese talk about yield curve control, but don't do anything about it yet.
Mike McKee, looking forward to that triple header. Much more from Mike through the week next week. Let's get you some movers going into the open. Here's Abby.
Well, we're looking at a strong rebound for the futures after yesterday's sell-off. Let's take a look at one stock that is weighing and then what is working. American Express, these shares are lower after the credit card company missed revenue and adjusted earnings estimates as card spending slows, a possible sign of a consumer weakening, growing tired, or even weakening. Tesla, after yesterday's big almost 10% drop on reduced profitability in the quarter that was, and the future potentially, we have a little bit of a rebound helping out both the NASDAQ 100 and the S&P 500 futures up 1.4%. Pushing it forward to next week, well, Meta reports on Wednesday. That stock, John, up more than 150% on the year. Will their growth estimates of 8% on top, 23% on bottom, will they need it? Talk about AI. It's going to be interesting to see whether or not investors think that this big run-up has been justified.
Abby, thank you. Coming up, tech earnings, briefly interrupting the tech rally.
Tech has tripped. One of our big questions coming into this reporting season is that earnings enthusiasm around growth going to fade a little bit and improve on the value side, and could that facilitate a leadership shift in the market?
Tech bouncing back this morning from one of its worst days of the year. Alphabet, Meta, Microsoft gearing up for earnings. That conversation up next with JP Morgan's Elise Ossenbach.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
mega cap growth in tech and the rest of the S&P 500 have basically been moving in tandem. So, the rally has basically widened out, but I would, keep that neutral rating basically on mega cap growth in tech. It's not a negative fundamental view. It's just a question of what's already basically in the price.
Disappointing results from Netflix and Tesla interrupting the monster rally in tech stocks this year. The Nasdaq 100 coming off its biggest day of declines in 5 months, fueling fresh concerns ahead of another busy week of earnings from Microsoft, Alphabet, and Amazon, all on deck. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, big tech definitely stumbling out the gate a little bit when it comes to the earnings picture. You had Tesla down nearly 10% yesterday, while Netflix was down by more than 8%. You add that together, the Nasdaq 100 plunged 2.3%, as you say, the worst showing since February. And of course, the big tech benchmark, it's still over 41% higher in 2023. But that rally is really built on 7 stocks, and that 7-stock rally is really built on optimism over AI, which brings this warning from chipmaker TSMC into focus. The company said that the surge in demand that they've seen for AI, it's not enough to offset a global macroeconomic slowdown. So we'll find out if that's a TSMC specific view or a sector-wide issue when the likes of Microsoft and Meta take the stage next week, a week in which more than 25 trillion worth of market cap is due to report their results. Though I will note right now, the Nasdaq 100 futures solidly higher this morning.
Big week for earnings just around the corner. Katie, thank you. JP Morgan's Elise Ossenbar seeing plenty of opportunities outside of big tech. Earnings season could be a catalyst for broadening out the rally. She says we recommend more exposure to cyclicals and looking beyond the magnificent 7 big cap tech names. I'm pleased to say Elise joins us now for more. Elise, wonderful to hear from you because you've been constructive and right through 2023. Correct to be constructive on this equity market. Tell me why you think we can make new highs.
Look, our base case does have us trading about sideways between now and 1 year from now. But that bull case is really starting to get more attention amongst investors because if we zoom out and think about how things have shifted, especially since the spring, the setup is looking more favorable. The soft landing scenario is definitely being discussed a lot as inflation comes down and the Fed likely gets closer to a place where they can pause. You haven't seen bank stresses kind of boil over to the degree that people might have feared with deposit balances, staying steady for the large banks and actually increasing for some of those smaller regional banks. And earnings have this momentum and we think are probably troughing right about now with potential upside in the future. So having a lot of conversations with investors about rebuilding those equity portfolios that they can carry not just through a potential recession, but into that cycle ahead.
And potentially rebalancing away from tech. So let's dig into that and talk about the earnings we've had so far. D.R. Horton came out yesterday. Here's an example. Home builder in America, decent numbers, upside surprise, ended the session lower. Elisa, what are you learning? Early days, I know, Elise, but what are you learning so far from how the market is responding to the earnings that are coming in?
Look, I think the market hadn't yet fully appreciated the potential for earnings overall to surprise to the upside. When we kind of pick apart the different sectors, we do think that this earnings season could be a catalyst for a broadening out of this rally. I think there's a lot of anticipation and good news already priced into the mega cap names. And when we start thinking about what's kind of going on with the cyclical economy, given the consumer resilience we've seen in particular, it suggests that there are opportunities elsewhere. So seeing a lot of traction with investors, looking at things like the equal weighted S&P 500 and adding exposure there via things like structured notes.
So that's the index. Let's get beneath the index and go sector to sector. At least discretionary has been huge this year. I talk about the airlines every day at the moment. The cruise line operators, they've boomed. That trade's done. Some people think it's already done. It's over. Are you still looking for those to make a move? Are you looking elsewhere? What are the parts of the market that have lagged that you think can pick up?
Sure. I like kind of thinking about longer-term investment opportunities versus shorter-term investment opportunities. So long-term, very excited about some of those trends related to things like artificial intelligence, but also, the potential for more infrastructure spending. Don't forget that we have over $2 trillion worth of infrastructure spending earmarked for the next 10 years. So we think that that could continue to be a boon for industrials. Near term, we're starting to do some of the work on sectors that have been relatively unloved recently. Think energy. strategy, given the amount of negative earnings revisions we've been seeing there, and also the beat up in valuations that the sector has kind of experienced.
You're not alone. Looking for this rally to broaden out, to rebalance away from big tech. Elise, you were constructive and you were right so far this year. Elise Ossenbar looking for a whole lot more from this equity market, potentially more highs and that shift away from the market cap weighted S&P over towards the equal weight. We've heard that a lot on this program, haven't we, over the last couple of weeks. Equity futures right now on the S&P 500, they are positive by 0.5%. They are up on the NASDAQ as well. The next week, we've gone through the earnings calendar for you. Alphabet, Microsoft next Tuesday, Meta on Wednesday, Amazon on Thursday. The following Thursday, you're going to hear from Apple. Coming up on this program, the morning calls, and later, Keith Lerner of Truist makes the case for not chasing this equity market rally. That conversation about 7 minutes away.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Away from the opening bell, equities up here, a lift on the S&P 500, positive by 0.5%. The NASDAQ, worst day since February yesterday, bouncing back on the NASDAQ 100 by 0.7%. That's the price action. Let's get you some morning calls. Deutsche Bank downgrading Sirius Radio to sell from a buy, saying recent gains are being driven by technicals and unusually high short interest. That stock is down 10%. Next up, D.A. Davidson upgrading Harley-Davidson to buy, expecting the company to top increasingly low earnings estimates going into next week. Their stock is up by almost 4% in early trading to $37.95. And finally, Piper Sandler downgrading Carvana to neutral, seeing limited upside after a monster rally earlier this week, popping 20% on quarterly results and a debt restructuring. That stock is up by 0.6% this morning to about $47 a share. Coming up on this program, Wall Street keeps chasing the rally as stocks continue topping year-end projections. That conversation up next with Keith Lerner of Truist. Your opening bell just around the corner.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I did not get the pink memo this morning. TK did. Pink bow tie, leopard print shoes, should have seen it. Brutal. Equity futures right now on the S&P 500, positive 0.4%, up on the session, up on the week. The Nasdaq yesterday struggling. Netflix, Tesla, taking a bite out of the rally so far year to date. Just a small one, biggest one-day drop. Going back to February on the Nasdaq, a lift into the opening bout. There's the opening bout. Switch at the board and get to the bond market. Yields look like this on Treasuries, down 3 basis points on a 10-year to 3.82. Yields up yesterday off the back of a downside surprise on jobless claims. In the FX market, heading for the biggest weekly loss going back to May on a euro against the dollar. Having a look at 113 earlier in the week and now backing away to 111.30, unchanged on the session. Crude up by 0.8%. WTI $76.30. We're up there by about 65 cents on the session so far. In the session at the moment, about 30 seconds in, we are positive by 1/3% on the S&P. On the Nasdaq, we're up by about 0.6%. One mover to take a look at, American Express. Shares under pressure after delivering disappointing revenue numbers. The CFO saying spending levels are, quote, more stable now following the post-pandemic boom. Abby has more. Morning, Abby.
Good morning, John. And lots of nuance here to this American Express quarter. And the stock is down just moments ago, the worst day in more than 2 months. Now, I misspoke earlier. They actually beat earnings relative to consensus. It was the BI estimate that they missed, and that's on increased expense or lower expenses than expected. But revenue, yes, it's interesting. They missed the growth estimates, but what makes it so nuanced, they actually put up record volumes of $426.6 billion, but that missed the estimate, so you know how it goes. Investors a little bit disappointed, but the company talking about the idea that despite this, I would think that this would maybe point to some kind of consumer spending slowdown. They're not saying that at all, that the consumer spending is still, quote unquote, really strong. So it's going to be interesting to see how this stock plays out. Again, lots of mixed messages here. Right now, the stock is down 3.7%, down closer to 4%. So the bears are taking it at this moment, John.
Abby, thank you. Allow me to draw your attention just to a headline, just quickly. The former President Donald Trump, the classified documents trial has been set. The date has been set for May 20th, 2024. What we're going to do now is get Anne-Marie down in Washington, D.C. When she gets to the camera, we'll have a chat to her about that. But that's the headline that's just come across, that the classified documents trial for the former president, the date has been set for May 20th, 2024. AMH coming up very shortly. Allow me to turn to the financials. The regional banks this morning, more earnings results coming from Regions Financial and Comerica, both seeing jumps in net interest income despite concerns about credit contractions. Let's get to Shanali for more. Hey, Shanali.
John, if you take a look at this week, the regionals are really coming out clean, pretty much. You're seeing deposit pressure still at the banks, but you do have net interest income coming in pretty strong here. Jumps from a year ago and above expectations. Now, that's not across every bank, but it's certainly across these two regions and Comerica. Also for these two banks, that is even including pressure on net interest margins, a little bit below expectations in some regards, but importantly, provisions for loan losses have been better than what Wall Street estimated. So that means that they're both making money and credit standards are still holding up. Now, the hope is that this follows through the season, but the KBW Bank Index certainly has had quite the rise this week with a lot of these fears easing. Some analysts take Mike Mayo feeling like the worst is certainly behind us. Though profitability pressures still exist, it's nothing to cry home about after the sell-offs we've seen this year.
3 months ago feels like a lifetime ago, and I guess that's good news for many of these banks. Shanali, thank you. Let's stick with the earnings. CSX shares falling after the rail freight company reported Q2 revenue that missed estimates. The CEO writing this, activity remains challenged. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, CSX shares currently off more than 5% after those results. So let's get specific here. EPS came in at 49 cents, which was actually in line with estimates, but you had revenue and operating income come in lighter than expected. Now, the company said that it was lower fuel and coal prices combined with weaker shipping volumes that dragged sales lower. And like you said, the CEO himself saying that this activity is going to remain challenged. So Wall Street was actually pretty fairly downbeat on these results. You had Citi and Susquehanna, both of those banks, cutting their price targets on CSX. And Citi in particular still has a buy rating on CSX, but it said that these results are, quote, they did not live up to expectations and that the volume outlook remains uncertain. And once again, you can see that in the shares this morning, currently off by more than 4%.
Katie, thank you. Katie mentioning a couple of houses, banks, brokers with some views on this name. Here's another one on CSX and the rails. Morgan Stanley warning the markets could overreact to its modest earnings miss. Here's the quote: CSX was expected to be the only rail that could beat this quarter, so the miss may really disappoint. Let's go from the railroads to the autos. AutoNation topping earnings estimates. The CEO saying the strong performance during the quarter reflects the continued resiliency of our operations and the benefits of our diversified model. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, shares up, down all around in pre-market trading, but settling decidedly lower, down nearly 6% in trading this morning. This despite the fact that it did beat adjusted earnings per share pretty handily, $6.29 a share, topping the $5.89 that analysts had expected. But this was 20 cents lower in terms of earnings than last year. We're seeing a decided shift towards newer cars. This as used car sales falling, new vehicle revenue growth up 12%. So it's still making money, even though car values are a little bit lower, but we're clearly coming back to earth after that excitement during the pandemic. You know, one cause for caution here, and maybe why we're getting a little bit more negative response in the market today, is the gross profit on those new vehicles falling under $5,000 per vehicle for the first time since Q3 2021. Used car profit also falling. That said, on the positive side, you know, shares up more than 50% so far this year, so maybe just an end to that rally today.
Stock is down 5.6%. Simone, thanks for that. The latest there on AutoNation. The broader market at the moment positive by 0.4% on the S&P, on the Nasdaq up by 0.75% currently after a big first half of gains. Stifel's Barry Bannister expecting the equity market rally to start stalling out.
Everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You know, you really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500.
Bannister reiterating Stifel's 4,400 price target for the S&P this year. This coming as Wall Street continues chasing the rally, with roughly half the survey strategists raising their year-end forecasts already this year. Keith Lerner joins us now for more. Keith, you can feel it. People starting to chase it. What are you advising your clients should do?
Yeah, well, great to be with you, John.
So what we did actually, we came into the year a bit more on the defensive side. When we broke above 4,200, we upgraded our view on equities to neutral. We also did it back in early June in the equal weight S&P. I know you just talked about it. It seems like everyone's talking about the equal weight S&P, the average stock, which has lagged. We still think there's a little bit more juice in that overall trade, but from a big picture right now, we're strongly neutral, right? Strongly neutral against stocks, bonds, and cash. There's a lot of cross currents. This post-pandemic cycle is challenging the traditional playbook, and we're respecting the underlying trend. We don't think this is a runaway bull market. You know how you have a forward PE around 19.6, and we're going to hear from the three central banks next week as well.
Keith, I'm with you. This is so hard to read. I was reading your note, and you're dead on. Mortgage rates are at something like 7%, and the home builders have ripped all year. Makes sense of that. Manufacturing's in recession, unemployment's still at 3.5% because services are robust and discretionary spending through the roof on things like airfares and taking cruises. Keith, how on earth do you make sense of where we are currently?
Well, I think because this post-pandemic period, I think that the stimulus, which is still, coming through with the infrastructure bill, the CHIPS bill, has been underestimated. As much as how big it was, people thought it was done and there's no lingering impact. I think that fiscal impulse has been stronger. And I think on the other side, Jonathan, a year ago, if you and I were talking and we said the Fed funds is going to go from 0 to 5%, you said, Keith, what do you think about the economy? I don't think we would be arguing whether we would be in recession. We would be saying how deep. And what's been the biggest surprise is how resilient the economy has been. And the economy has been somewhat less interest rate sensitive, partly because of those locked-in mortgages, partly because of corporations have termed out debt. But, that's the surprise. So I think at this point, you have these cross currents. I don't think this is a fat pitch as far as where the market is. A lot of the gains recently is repositioning. So I think you stay close to your long-term targets and be more patient to go either on defense or offense, later on in the year. But just right now, I think somewhere in the middle makes sense based on those cross currents.
Keith, you're right. 12 months ago, it wasn't about whether we'd have a recession. It was about how deep it might be. You know what the conversation at the start of the year sounded like when equities started to rip and tech started to dominate? It was just bear market rally, bear market rally. And here we are 6 months later, 7 months later, and I still hear some people saying this is a bear market rally. Keith, who's to say this isn't the start of a runaway bull market like 09, like 20? Why isn't it that?
Yeah, listen, it could be, but I think our base case is it's not. And I'll tell you why, Jonathan. So when I think about the beginning of big bull markets, you have one depressed sentiment. So I think we can agree that sentiment was very depressed coming into this year and over at those October lows. You also bottomed last October when inflation, had spiked to the highest level in decades. So that's great, but starting valuations today at 19.6 multiple for the S&P. That's the highest valuation outside of that pandemic overshoot that we've seen for the last 20 or 30 years. So starting points are much higher. And then what's really important is that policy from the fiscal and monetary side going forward will be constrained. What tends to really support those big, long, sustained bull markets is liquidity coming into the market. Jonathan, I don't see liquidity coming into this market in any big way, in the near term or even over the next year.
A week ago on this program, Mohamed El-Erian turned around and he said, this is a soft landing narrative that you do not want to fight. I've heard others say we're in this sweet spot that could last a few weeks, last a number of months. Keith, do you not subscribe to that at all, that the data over the next couple of months is going to support this idea? Whether it happens or not, people will believe it because we're going to see more disinflation, more robust labor market prints, and people will get on board with this soft landing theme.
Well, I think that's probably already what we've been seeing. That's one of the reasons why we upgraded equities, seeing that the positioning was offsides, which already is starting to be covered, and we're going to see disinflationary trends in the summer months as well. And again, the market was caught offsides. As we get into the fall, I think as you think about base effects on inflation, maybe we get a little bit more stickier there and it becomes a little bit more problematic. And also as you move in a little later in August and September, historically, that's when the volatility index starts to move up. And there's probably something that, 3 months from now, Jonathan, that we don't know that's coming, we're going to be talking about that will change the narrative as well. So listen, at this point, we're respecting the underlying trend. We moved our equities within equities. We're staying with the U.S. We're still Team USA. We're focused on large cap. And I would also say we see some value here in the 10-year, at 3.8%, even a little bit longer duration, just to hedge portfolios for some of these cross currents that I've talked about.
Andrew Balls of PIMCO said the same thing 40 minutes ago. Keith, one more question, then I've got to get to my colleague down in Washington, D.C. But if you had a pick right now, if I could give you something up front, would it be the Fed decision and news conference with Chairman Powell or tech earnings and those results next week?
I will say tech earnings. Tech earnings are important. I mean, you look at the market this year, the technology sector's up over 40%. We all know the story about how much they've driven the gains. So tech earnings are going to be, very important as far as holding up this market and what's happening, what's happening next. Our baseline view, though, we upgraded tech in March. We think we're in a resting period. We still think tech is leadership. I don't have a big call about this earnings season per se, but if the economy does slow down later in the year, as we expect, I think companies are going to have to continue to invest in technology regardless, and that should support better earnings from tech relative to the broader market.
Okay, Keith, thank you, sir. Keith Leonard there of Truist. Your equity market at the moment positive on the S&P. Some breaking news just moments ago. Let's get down to Washington and catch up with Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John, we now have the date for the trial of former President Donald Trump related to that classified documents case for which he is facing 37 counts of 7 different federal charges that he, of course, has pleaded not guilty to. May 20th, 2024. And in theory, John, this is probably not great news for either the defense or the prosecution. Prosecutors at the Justice Department had wanted to try this case this coming December, while former President Trump had bid for it to happen after the 2024 election because, of course, he is seeking the Republican nomination, which makes this timing, John, incredibly interesting because in May 2024, we will be post the Republican presidential primaries, but before the convention that is taking place in the summer. So potentially a very politically sensitive time for the former president. And he could be dealing with a number of other legal challenges at that time as well. As we know, he hasn't just faced this federal indictment. He already was indicted in New York on state charges. Earlier this spring, he could be facing down another potential federal indictment from Jack Smith, the special prosecutor who brought this case. President Trump himself said he received a letter from Jack Smith just days ago saying that he is a target of an investigation related to January 6th and efforts to overturn the 2020 election. He is also facing potentially an indictment in August in Fulton County, Georgia, also related to the 2020 election. So the litany of legal challenges really stacking up for the former president. And again, he will be going to trial in Florida on May 20th of next year, John.
Katie, thank you. It's on the calendar in bright red. There we go. That headline just crossing. Katie Lyons, May 20th, 2024. We'll turn to that a little bit later on Bloomberg TV and on Bloomberg Radio. Balance of Power later on this evening, 5 p.m. Eastern Time with Katie, Anne-Marie and Joe Matthew. Coming up, preparing for another big week of tech earnings and for big tech and the Nasdaq's rebalancing.
Some of these names are in the Magnificent Seven, and they were easy to jump onto when, the market was going up straight almost for 3 months in a row. The healthiest thing would be that if money started to flow into other areas of the market and broaden.
That conversation coming up next.
No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but...
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Earnings the next couple of weeks are going to be so important, right? These companies' valuation has expanded, sentiment's quite high. And not only do they need to hit their numbers, they really need to satisfy the sentiment, right? And they need to keep the animal spirits going in those stocks. So you could have a situation where they nail the number and the guidance or the discussion around AI, for instance, isn't quite as exciting as people would hope for, and the stock could come under pressure.
Big tech bracing for the Nasdaq special rebalancing. Chris Harvey of Wells Fargo writing, quote, the upcoming rebalancing is reducing concentration risk but creating uber cap selling pressure, with near-term liquidity demands likely weighing on the group. Let's get to the team coverage. Kelly Greifeld and Mandeep Singh join us now for more. Katie, first to you. Talk to me about this rebalancing and what to expect over the next couple of days.
Well, it's special, it's out of cycle, and of course, this is designed to reduce the weight of those top 7 stocks in the Nasdaq 100 from a current combined weight of 55% to just under 44%. And it's scheduled to take place today in anticipation of Monday's opening. But today, in addition to it being a special rebalance, it's also option expiry day. So just to complicate matters further, we have about $2.4 trillion worth of options set to mature today. So usually that introduces some fireworks headed into the close. The fact that you also have this special rebalance on top of it, it could tick up volatility even further, of course, as money managers try to navigate that, try to bring their portfolios really in line with the new benchmark.
Several risk events for the Nasdaq, including the earnings as well. Mandeep, next week, Alphabet and Microsoft on Tuesday, Meta on Wednesday, Amazon on Thursday. The week after that is Apple. For you and the team, Mandeep, which names are you focused on more than others?
I think right now the focus is definitely on the internet names and notably Alphabet. Given, we have had a great run for all the other mega caps, Alphabet so far has somewhat missed out, and the ChatGPT overhang, you can see that on the stock. Based on the work that we have done, we've seen, YouTube trends are holding up very nicely. In fact, we think YouTube has taken share in terms of time spent on streaming platforms from the likes of Netflix. And cloud, look, I think you're going to see a benefit accrue to all the cloud vendors from AI because there is that insatiable demand. And so I think both Microsoft and Google and Amazon are going to call out AI demand on their clouds.
Mandeep, yesterday we were drowning in news from Netflix, drowning in news from Tesla. There were some headlines around TSMC that hardly got any coverage whatsoever. I actually got a couple of messages about it over to Bloomberg. Mandeep, what was important about what happened with TSMC yesterday?
Yeah, so they called out their AI revenue, which is 6% of their overall revenue, but they expect 50% CAGR over the next 5 years. So I think to put it in perspective, yes, the traditional CPUs and your traditional PC chips are still seeing weak demand. But when it comes to this new pocket of growth, even they call that out. So I think for a vendor like Apple, that may not sound very good because obviously they are more exposed to smartphones and that didn't seem to be that good for this quarter. But I do think for AI, I mean, NVIDIA and the likes, this is pointing to the demand, and this is going to hold.
Interesting. Mandeep, thank you. We'll catch up with you next week. Katie, thanks to you as well. The broader market fading a little bit here. 22 minutes into the session. We're still positive, but only just by 0.1% on the S&P 500. Let's lift the lid on this index and get you some sector price action. Here's Abby.
Well, John, let's take a look at the sectors here for the S&P 500, and we are going to see that on the day, earlier to your point, we did have broader gains, but similar to yesterday, we have some strength here from a composition standpoint, more sectors higher than not. That said, utilities, that's a defensive sector. That's the best sector on the day, so perhaps not the most bullish sign. But right below it, tech, and then on bottom, we have materials, financials, industrials, and energy. Interestingly enough, a couple of those sectors are actually the top sectors on the week. If we take a look at what's happening on the week for the S&P 500, we will see the energy up from sort of a stealth perspective, up 2.6%. Financials up 2.7%, as most of those big banks have reported, and many of the regionals. And then finally, consumer discretionary, well, that has everything to do, of course, with Netflix and Tesla yesterday, and communication services, similar deal.
Abby, thank you. Your trading diary up next.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Five minutes into the session this Friday morning. Good morning to you. Approaching 26. We're positive here by 0.2% on the S&P. On the NASDAQ, bouncing back from the biggest one-day loss since February. We're higher by 0.4%. That's the price action. Here's the trading diary. Coming up, going into the weekend and beyond. US PMIs and the NASDAQ's rebalancing taking effect on Monday. We get earnings from Alphabet and Microsoft on Tuesday. Meta results coming on Wednesday. Plus, we get a Fed rate decision and Chairman Powell news conference too. Full coverage, of course, here on Bloomberg TV and radio. An ECB rate decision coming up on Thursday, US GDP and Amazon earnings as well. And finally, rounding out the week with a BOJ rate decision and Exxon earnings on Friday from New York. That does it for me going into the weekend. Have a great one. Enjoy the rest of the trading day if you can. This was the countdown to the open. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe its central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Happy Friday, everyone. I'm Madison Mills here in our Interactive Brokers studio, joined by Simone Foxman, our first time on air together in the States.
So
I'm buzzing. I'm absolutely buzzing this morning to be with you. Simone is a great asset to us, and she's going to give us all of her equities knowledge today. We've got a lot to cover here. Seen some green on the screen. Not a lot of volume, though. S&P up by just about 0.15% here on the day. The NASDAQ up by 0.2%. We're going to cover all of this for you, but first we got to get a little flash with our very own John Tucker.
All right, let's start you off with the markets in the green after yesterday's sell-off. The Dow Jones Industrial Average right now is 5 points higher. The S&P 500 up 5 points. The NASDAQ 100 after yesterday's sell-off right now 30 points higher. That is up 0.2%. Of course, the investor focus is going to be next week on the Federal Reserve, the Fed meeting, big focus there, and Nadia Lovell at UBS expects one and done from the central bank.
We think that we'll get the last hike next week, so we're looking for that terminal rate to be 5.25% to 5.5%. But I think it's important to note that we don't think that Powell will signal that it will be the end of the tightening cycle just yet. The Fed wants to maintain that optionality.
Well, there's a confluence of events taking place in the markets today. Could be a day to remember. The NASDAQ rebalancing on Monday. The idea to reduce the dominance of the big tech mega caps and boost the presence of some of the smaller members. Now, before it happens, Investor Day, they're going to need to bring their portfolios in line with the benchmark. And if that's not enough for you, $2.4 trillion of options contracts tied to the stocks and indexes, they are set to expire today. So the watchword for today, volatility, maybe some big price swings. As we look at yields right now, 2-year yield, 483, pretty much unchanged. the 10-year at 381. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and maybe it's too much Tucker, I suspect, this morning. But
oh,
there
never
you
too
go.
much Tucker, John. Never, 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 especially for
Don't worry,
Friday.
Paul's back Monday, I think.
Paul's back on Monday. Thank God for every one of our listeners out there and viewers on YouTube. Want to welcome you guys. Just go to Bloomberg Global News on YouTube if you want to watch our faces as we cover the news today. We've got a lot to cover when it comes to the equities market, as John was mentioning, some moves on the day, a lot to digest. So we're going to get to all of it with an incredible equities reporter. We've got Alexandra Semenova in studio with us. Alex, thank you so much for joining us this morning. You just filed several stories this morning, but the one I want to talk to you about is this B of A note on the S&P broadening out. Talk to me about what we should know on that.
Well, good to be on here with you guys. Happy Friday. Bank of America just released a note today from Savita Subramanian, one of the top equity strategists there. She's saying that she expects the equity rally to broaden out, that the S&P 500 gains have kind of started to broaden out in May, and that trend is going to continue. An interesting statistic in that note, she says that the top 7 stocks that drove returns this year trade 44 times trailing earnings compared to the rest of the index trading at 17 times earnings, which leaves a lot of opportunity for upside in the laggard. So this comes at a time where a lot of investors have pointed out this narrow leadership as a reason to stay away from stocks kind of resemblant of the dot-com bubble era, kind of worried that, you know, this AI rally might kind of fizzle out and there's not much staying power here. But on the other hand, there are a lot of optimists saying that this extreme concentration is actually a good thing because it's usually followed by outperformance in some of the names that still have catching up to do.
Alexandra, talk to me a little bit about this thing we're expecting today in the NASDAQ 100, a flood of options expiring, but coming after the worst day for the NASDAQ 100 in 5 months. What should we expect today?
Yeah, so that's going to be interesting. It's going to take effect on Monday. However, you know, the whole point of it was to address this extreme concentration, to kind of reshuffle things because there's so much focus on these several names. However, strategists at Goldman Sachs pointed out that it's not actually going to do much to change things. We could see some volatility there as these options, you know, as they hit their deadlines, as we see this reshuffle, but it's not.
How much volatility do you normally see on days like this? Do you have any sense?
I can tell you that we have a great reporter on our team, Elena Papina. She is the options expert, so you guys might have to get her on the show.
But volatility, brace for volatility. But we'll see.
It's important to note, though, that yesterday was a little bit of a scare with Netflix and Tesla's earnings kind of taking some of the shine off the NASDAQ 100. But it's really normal for the market to take a breather when it's had such an incredible run. It's not necessarily a bad thing. We're still seeing, you know, soft landing inflation, optimism intact, driving the market higher. We're on pace for a weekly gain. So things are still just fine, it seems.
Yeah, but to your point, Simone, the NASDAQ did have a pretty volatile week because of those mixed tech results. Alex, can you talk to me a little bit when it comes to the trade on the day here? I want to go into some movers with Amex as our starter. What do we need to know about why they're in the red today?
Yes, it was actually a pretty quiet earnings morning today before things pick back up again, but American Express was in focus last time I checked my terminal. Shares were down about 5% after the company missed revenue forecasts. A volume on American Express's network increased 8%, which was the weakest gain since the first quarter of 2021 and a smaller gain than analysts expected. There is some slowdown in credit card spending growth. However, another interesting point in their earnings results, which is kind of a reflection of the state of consumer, is they said that travel and entertainment spending jumped 14% in the quarter. So that kind of speaks to the shift in spending on experiences and services versus goods, which we saw earlier during the pandemic.
Yeah, it looks like shares now down over 5%, the most since June 2022 for Amex. What else are you watching today?
So a very interesting thing that we've been talking about a lot on our equities team is how strategists got things so wrong in the first half of the year. Going into the year, everyone's S&P 500 forecast essentially said that the index would end the year pretty much where it was at the end of 2022, and instead we got this incredible rally that was really showing no signs of abating. And so John Authors had a great column this morning. He says that it's a strategist short squeeze. It's kind of forcing the hand of some of Wall Street's biggest bears. One of them yesterday was the latest to cave, Michael Kantrowitz over at Piper Sandler. He had the lowest target on the index, 3225, and he actually upwardly revised it to a range of 3,600 to 3,800. Mind you, that still reflects a 15 to 20% drop. I spoke to him, I checked in with him. He said that he still sees a move lower for stocks. He's worried about recession expectations rebounding. He's worried about earnings. However, the reason for the upward revision was because stocks have run so far, and he just thinks that his anticipated 30% drop is now unreasonable. So it's still interesting to see, these mega bears kind of being forced, cornered into changing their outlooks.
Right. Well, it feels like clients must be saying, you need to give me some of the returns that we missed out on in the first half of the year. I'm curious, Alex, when you're having conversations with your sources, what are you asking them in order to indicate how they're going to save themselves in the second half of the year if they did miss out on that initial rally? What kind of questions are you asking to determine how they're repositioning, how they're thinking about getting some gains in for the second half of the year?
Well, my sources who are a bit more skeptical on stocks, I always ask them, what is the catalyst that you need to see to get back into a risk-on mood, to start kind of piling back into stocks? And their answer still is that we want to see a recession. We want to see the labor market break. We want to have that bottom that will tell us that, okay, the Fed is actually going to cut rates and we can finally get back into stocks. However, that's kind of changing a bit now because everyone's talking about a soft landing again. And, Deutsche Bank made a point that before they thought it was inevitable that a recession would have to happen, but now it's kind of a toss-up. Inflation is coming down. The Fed is still going to hike, but it doesn't look like we're going to see the downturn that a lot of people were worried about.
Right. Yeah, and that is actually the title of one of our stories running on top on the Bloomberg terminal this morning. U.S. recession becomes closer call as economists rethink their forecasts.
Like, I need it to just happen already. You know what I mean? We've been talking
or not.
about,
You
or
know,
not.
not.
I just want a finality because as we always joke about the most anticipated recession of all time. Can we just get to the end of this? But go ahead, Simone, I'm sorry.
Yeah, no. How much focus is there? We have a big week of data coming up. We have a big week of earnings. Number one thing we should be watching, or strategists that you're speaking to are watching for next week.
Well, it's all about the Fed meeting next week. Investors are largely anticipating another rate hike, but the question is it going to be the last one? And that's kind of going to be the thing that drives stocks in the second half of the year. Whether we'll see kind of peak rates, that's been reason for optimism, and that's what investors are looking at next week. We'll also get a reading on GDP, so we'll see how well the economy is holding up, and that is going to be there along with earnings.
Perfect. All right, Alex, thank you so much for joining us. We're going to get you back in studio in a little bit to give us another update. Really appreciate it. That was our equities reporter, Alexandra Semenova, giving us the lay of the land when it comes to the trade today. We are going to pivot a little bit to go more macro here. We've got our very own Michael McKee, international economics and policy correspondent. And our guest note for you, McKee, I'm learning so much. You were a White House correspondent?
Oh yeah.
I didn't know about that.
Years ago.
To me, you're just literally the Fed person, and you came out of the womb covering the Fed.
I did politics for 20 years, and I spent 9 years at the White House, and I got bored. And they said, "Okay, you can do economics."
You got bored at the White House?
It's not as much fun as people think.
Pre-2016,
it's great to do the big stories of the day, but you can't go anywhere. You can't. You can only talk to people on the phone.
Yeah.
And when you travel with the White House, you travel in a giant cavalcade, like a circus. You fly to a city, you get on a bus, you go to a hotel meeting room, and then you get on the bus and go back again. You can do a lot more on other beats.
Well, and as you've proven on the Fed beat. So talk to me about what you're looking at when it comes to next week. It's kind of foregone conclusion that we're going to see a hike. What is your question going to be when it comes to speaking in the Fed meeting afterwards? What are you looking to hear from Powell?
Well, we're going to fly to Washington and get in a taxi and go to a meeting room and wait for Jay Powell.
So very similar.
The thing that everybody wants to know is what's next. There's a 95% chance priced into the market that they're going to raise rates, and that's basically 100% given the complexity of that calculation. And so do they go another time, given that the data suggests they don't have to at the moment, but there are reasons to think the data might turn around. And so that's going to be kind of a question that overhangs everything in the Fed meeting. Do they go again? And if they then are going to go again, do they wait until November and do another skip in September?
Do you anticipate them saying anything in that Fed meeting next week that will indicate what they're going to do next? Or is it going to be, we're open, the totality of the data?
Yeah, I think the latter, because they don't want to lock themselves into something, because we're going to have a lot of data between now and, say, November. If they wanted to sort of program a skip in there, you'll have a number of employment reports and CPI reports and PCE reports. So the whole character of the debate could change very easily.
Yeah, and we have a slew of economic data coming out next week as well. You know, if you were to pick kind of one data point that you're most focused on, following the Fed, what would it be?
Well, Friday's PCE report will tell us a couple things. One is in their favorite inflation indicator. It's expected to drop the way CPI did, maybe not as much, but to show progress on inflation, but also spending. Are consumers holding up? Are they still spending but at a lower rate, which is kind of what the Fed wants to see? They want to see demand come down a little bit. So those are going to be perhaps the most interesting things of the week that tell us something about what's happening going forward. The GDP report will also give us some idea of how the economy is holding up, and it's, according to all the nowcasting ahead of time, it's holding up much better than people thought. And that may change some minds about, in terms of economists' forecasts for what's going to happen. And if it comes in strong, especially consumer spending, you could see an equity rally on that basis. Although you always have to discount the fact that then the markets think, oh, they're going to raise rates more. Right. But it would show that people are still spending money.
Yeah, and that personal consumption piece of the GDP last time coming in quite strong, holding up the overall number, and then revisions coming in higher as well. I mean, when you think about consumer spending, I mean, the kind of notes we've been getting from earnings calls are like, hey, we're seeing a wall, we're hitting a wall, and yet the data seems to come in, continually more positive than anticipated.
Yeah, it all depends on the categories, the sectors that people are spending money in, and how you define a wall. If you had been seeing sales grow at a 4 or 5% rate, and then they drop down to 2 because the Fed's interest rates are higher, or because the economy slows a little bit, that's okay. If a wall means 0, and then of course what we've got is a lot of retailers reporting and retail sales numbers that have come out that are weak or weaker, but we don't know what's spending in services has been like, and you don't get earnings reports from the corner dry cleaner, so that's what we're going to be looking for.
How much is the Fed looking at those earnings results?
They look at them, but the market isn't their primary concern. As long as trades can happen, then their view is stocks go up, stocks go down. So obviously earnings impact asset values, and asset values are all part of inflation as well. So it's something they keep an eye on, but it's not something that drives their decision making.
Yeah, we were just talking with Alexandra about, one of our top headlines today, U.S. recession becomes a closer call as economists rethink forecasts. Has the Fed rethought its take on whether we do need to see thoroughly indicators move negative, at least a shallow recession? Are you getting any signals?
No, actually, they've been pretty consistent. Fed officials have all said they don't think we need to have a recession. And of course, Chris Waller way out in front saying a year ago that we could get by without a recession and without seeing unemployment rise significantly. The Fed staff has consistently at the last 3 meetings forecast a recession at the end of the year. It will be interesting to see when we get the minutes of the meeting next week, 3 more weeks for that. whether the Fed staff is still in the recession mode.
Yeah. Okay. Final question for you, McKee. We've got about 30 seconds
Final
here.
Jeopardy here.
Final Jeopardy here. How many data points do you think the Fed needs to see that look like last week with CPI non-farm payrolls to justify an end?
Probably one or two more, depending on how much the numbers move.
Yeah.
If you got a big drop, then maybe they can start to feel good after one, but I think they want to see two at least to give them the idea that this is not going to turn around immediately.
Yeah. A lot to monitor for them because it's very confusing how much is going on out there with employment looking great, GDP staying strong, and then you've got on the other side of things, consumer spending starting to buckle a little bit when it comes to the earnings picture. Michael McKee, thank you so much. As always. You know I love to spend more money.
You got to go out and spend so that we can save the economy.
Oh, I'm spending. Don't worry about me, McKee.
Yeah.
It's summer, exactly. All right, guys, thank you so much. Michael McKee with us there, covering all of the Fed moves for us. We're going to get some company news now with Bloomberg's very own Steve Rappaport.
Good morning. Tesla shares started up and are now down after yesterday's skid that took a big chunk out of Elon Musk's fortune. Bloomberg's Charlie Pellet reports.
The drop in net worth to $234.4 billion is the seventh largest decline ever among those in the Bloomberg Billionaires Index and further narrows the wealth gap between Musk and Bernard Arnault, the world's two richest people. Musk's fortune still exceeds that of Arnault, chairman of luxury goods maker LVMH, by about $33 billion. Musk derives his wealth primarily from his stake in the EV manufacturer, as well as his holdings in space exploration technologies and Twitter.
Thanks, Charlie. The FTC pauses its in-house trial against Microsoft's $69 billion takeover of Activision Blizzard. More on that from Bloomberg's Sarah Forden.
Doesn't mean that they've pulled it entirely. They could reschedule it, but at the moment, this will open the door to talks with Microsoft, which is now going to be able to come into the FTC and make any kind of settlement proposals that they might want to make to try to get the FTC to bless this deal.
Thanks, Sarah. The companies extended their merger deadline by 3 months as they attempt to win over UK antitrust regulators. Shares of Microsoft are up. Activision Blizzard, little changed this hour. And American Express stock dropped after the reported second quarter revenue missed estimates as spending growth on its credit cards slowed. But analysts highlighted Amex kept its forecasts for the year steady. The stock right now down more than 4%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After yesterday's 2% drop, the NASDAQ 100, it's higher, but it's paired some of the earlier gains. And investors also bracing for a pretty volatile session, flood of options expiring before rebalancing in the NASDAQ 100. That happens on Monday. So ahead of that, especially the index funds are going to have to change their makeup. Some of the forecasters who were first out of the box to predict a recession, they're starting to hedge their bets as the economy presses on. Deutsche Bank's Peter Hooper and Fannie Mae's Doug Duncan now say it's a toss-up whether there is going to be a recession this year in the United States. S&P 500 right now, that is 13 points higher. That's up 0.3%. We're at 47 on the index. The Dow Jones Industrial Average up 80 points, a rise of 0.2%. The NASDAQ 100, 36 points higher. That is up 0.2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Maddie and Simone.
All right, John, thank you so much. Thanks for giving us the giggles on this Friday morning, as always, here helping us get through the day.
I don't know what I did.
You just started laughing. It's contagious. I love it. All right, John, thank you so much. We are going to cover some mildly breaking news from this morning. We got the trial date for Donald Trump's classified documents trial, that date being May 20th of 2024. So we have a fantastic guest in studio with us. If Paul were here, he'd say you get extra credit, Wendy. This is Wendy Schiller. She is a professor at Brown University and can talk all things politics with us. So, Wendy, thanks for coming in. This May 20th date, it feels to me like this is bad news for the Justice Department, who wanted December, and bad news for the Trump camp, who wanted it to be after the November election. So how are you digesting that date, and is it good news for anyone?
Well, I'm not sure the judge split the difference, but if both parties are unhappy, that probably is a good thing in terms of how the decision was made. The primary season will be essentially settled by then. You know, the primary calendar is out now with some states unsettled, New Hampshire for the Democrats, for example. But nonetheless, you know, we'll know whether Trump is likely to be the nominee by May of 2024. It will shape the campaign itself, because if the nominee is decided, we think it's probably going to be Biden, and we think it may be Trump, then the American public's attention is on this trial. And so it will galvanize Trump supporters, but it might also continue to give independent voters, who are absolutely crucial in 2024, more pause about voting for the Republican nominee for president. And so that's how do the Republicans get around that? They're going to want to mobilize their base for congressional elections and the presidential election, but how do you actually get those voters who have rejected Trump for 3 elections in a row now to come back in the middle of a trial?
Yeah, how do the Republican challengers, the Ron DeSantis, the Nikki Haley's of the world, how do they play this, considering that, you know, the primary season is going to be largely over?
Well, I think they have to worry about August 23rd, Simone, more. You know, the first debate. You know, if Trump shows up, then they get to attack him directly, and we've seen them to be reluctant to do that. They're dancing around it. But Trump showed in 2016 that if you take your opponents head on and you show no mercy, you will do better with the Republican primary voting base. So they have to worry about how to get attention from now until December. And then if Trump is not on that debate stage, who's going to watch it? So I think their problem is momentum. And the other thing is, of course, the January 6th trial shoe. Like, when does that drop? And how do we manage, in terms of our justice system, these two very important federal trials?
Yeah, certainly a race for all these trials moving forward, which one gets the most attention first. But I mean, you know, you say that, you know, Trump showed the success of going out there being very forthright, but criticizing Trump has been a negative for lots of politicians over the past several years. Is there any signs that that's starting to change?
Well, the very famous, now long gone, Clark Clifford, political advisor, started out with Harry Truman, said you can't beat somebody with nobody. You have to actually present the alternative. Say, this guy can't win, I can win. Don't you want to be a winner? Trump has sold himself on being a winner, and the problem is now he has tagged Ron DeSantis, I think his closest, best-funded challenger, as a loser, even though I got reelected by massive numbers in Florida and supposedly still popular there. So Trump is just winning winning the PR war, exactly, Simone, as you say. And if you're not Chris Christie, who just doesn't care and is going after him, you lose that war before you get on the stage. You have to show Republican voters you're willing to fight. One of the things that keeps these voters loyal to Trump is that he has always been willing to fight, theoretically, for them, but also for himself. And that's a trait that seems to have really resonated and is sticking with them. So if you can't show that you're willing to do that on a debate stage with not that much to lose, I'm not sure how you ever pull like the 9% of that Trump base they're going to need to win the primaries.
Well, and you mentioned DeSantis as well. Why is he struggling so much at the start of his campaign, you think?
Madison, that is, political observer question. If we were talking 6 months ago, a year ago, it was that this guy is clearly at $110 million.
Yeah.
He's a lovely family, really, no scandals that we can think of, young. He would be the ready-made candidate. And he's just stumbled. And the problem is that he doesn't seem to be connecting with voters on the campaign trail.
Yeah.
And primaries are retail politics. So if you don't connect over in a large arena, you don't connect on television or media, and then you don't connect in person, there's no reason to switch your allegiance. And I think that's his big problem. And how you get over that, that's, you need a lot of PR training. I'm not quite sure. Yeah. It's whether the Republicans want to win. And there are enough Republicans, by the way, in the Republican primary base that if they all chose to go with somebody else, Donald Trump would not be the nominee.
Well, I guess the idea with DeSantis and the appeal for the conservative voting base has been that he's essentially Trump, but he knows how to play the system. And when you look at some of the plans that Trump has come out with recently to target migrants, bureaucrats, as well as ramp up his China, his pushback towards some of the policies in China. I mean, a lot of the things, specifically in the domestic side that he's suggesting, not necessarily going to get past the courts or Congress, et cetera. Does anyone care on the Republican side? Or?
Yeah, I mean, first of all, one thing we have to think about is Trump is the incumbent, right? I mean, he's not in office. He is not. He's former President Trump. But to the Republicans who voted for him and are loyal to him, he's still the incumbent candidate, incumbent president. So if you're not voting for him, you're sort of disloyal, right? It's like voting against Jimmy Carter or George Herbert Walker Bush when they were challenged in the primaries. So that's a psychological hit, right? How do you get over that challenge? And the second thing is Trump focuses on things that matter economically to a wide berth of people. Tariffs, China, the loss of jobs over the last 25 years because of our free trade policies, for example. He continues to do that, whereas DeSantis chose really social, not narrow, but social issues in Florida. Yeah. So how many people care about sort of what you're reading in a textbook in Florida? How many people care about what you can do in Florida? Whereas Trump has the opportunity to say, I was tough on China internationally, and I'm going after all the things that matter to you in Iowa and to Michigan and to Pennsylvania and Nevada. So this is the advantage Trump has, and it's a big one over DeSantis right now. So that's I think the big gulf between the two of them. No matter what DeSantis says about what he does internationally, Trump can say, I did that.
Right. And it's interesting because I was covering the DeSantis campaign for the midterms down in Miami and went to one of his events, and he doesn't want to shake hands. Like, it's the most simple things that you have to do on the campaign trail as a candidate that he's not necessarily willing to engage in, and that feels like the thing that Trump is so good at when it comes to engaging with voters.
And Trump is also, Madison, that's a really great point. And the other thing that Trump has been good at, as many people as he alienates, he also appeals, particularly in Florida, and you can say more about this because you were there, is that there's a bunch of people who are now foreign-born but naturalized citizens from a lot of countries in Latin America who are used to strong leaders, who like that type of leadership and may not be as liberal on social policies that the Democrats are used to thinking about, particularly for Latinx voters. So Trump did better in Florida amongst the whole people, in Miami-Dade, for example, and Biden did worse. And that's a scary proposition for the Democrats nationwide, particularly if you think about Nevada and you think about some other states that they need to, Arizona, that they need to really hold. And there's where Trump also understands that people are not monolithic based on whatever their background is. And DeSantis has nothing to offer these voters to say, I'll be better, or even in my persona, that I'm going to remind you of the way it was when there was order and stability. Sometimes I have trouble with this idea because if they left their home countries, there must have been something wrong with that. So we have to think about that. But this is a looming issue for the Democrats that I think they're not quite on top of right now.
Yeah, let's turn this to the Democratic side, though, because we had the news that an FBI document with purportedly, according to the GOP, evidence of bribes paid by Ukrainian businessmen to President Joe Biden and his son Hunter. Well, apparently it's not as clear as Republican lawmakers have portrayed it. Is this the end of this frenzy of headlines and news about this purported issue, these potential bribes?
You know, difficult relatives have been around in American politics for a long time for presidents. I mean, I'm old enough to remember Billy Carter, and it's way before your time, but he caused Jimmy Carter a lot of problems. Hunter Biden, in the end of the day, may be prosecuted or indicted or alleged to have committed other crimes, and he may, have to, do another plea deal. We have no idea, but there's no evidence that we can see right now that ties any of this to Joe Biden, and so I think that's a big hill to climb for the Republican Party. People may not love Joe Biden, but I don't think there's an inclination to think that he's super corrupt among independent voters and the Democrats, and so the independent voters are just key in all these swing states, and if you can't get them over to believe that, they can believe the sun went astray, but to have them believe this is going to take a lot, and if you focus everything on that, I think then the Democrats just bring up January 6th over and over and over again, and that's a direct allegation against former President Trump.
Right. We're going to have to bring you back on to talk more about Biden and Bidenomics as well, because I was hoping to get your take on how that's playing with voters. Wendy, thank you so much for joining us today. This is Wendy Schiller. You're hearing a professor at Brown University, political expert here. Really great to get your take, so we appreciate it. We're going to continue to cover all of the news that you need to know today for you. But first up, I want to get you a check on world and national news with our very own Nathan Hager.
Yeah, on top of that breaking political news, Madison, we've got some political news close to the tri-state. New Jersey has filed a federal lawsuit over New York City's congestion pricing plan. This is something that had been hinted at for several weeks here. The case names the U.S. Department of Transportation and the Federal Highway Administration as defendants, so it is a federal case. New Jersey Governor Phil Murphy has said drivers in his state would be unfairly burdened by the plan to charge Easy Pass drivers up to $23 to enter the city south of 60th. Those tolls are expected to help raise $15 billion for public transportation projects, and New York City officials say they could also cut downtown traffic by up to 20%. One of the greats is gone. Oh, the good life. Tony Bennett died today. The New York crooner made I Left My Heart in San Francisco his signature tune. Of course, he had hits with this one as well. Dozens of albums, 19 Grammys, and a late career revival with duets with the likes of Lady Gaga. Tony Bennett had been battling Alzheimer's disease for several years. He was 2 weeks away from his 97th birthday. AI says it can regulate itself. 7 top firms are going to be at the White House today to unveil voluntary safeguards. We get more from Bloomberg's Zach Cohen in Washington.
This is both people from the major tech industries, places like Amazon, Alphabet, the owners of Google, Meta, Facebook's Meta, Microsoft, as well as some of these newer firms that are deliberately focused on creating this new artificial intelligence.
Bloomberg government Zach Cohen says the companies are agreeing to internal and external tests for security flaws and biases in AI. Round 2 of the British Open, Brian Harman is your leader, 10 under through 6 in the second round. Second place, Tommy Fleetwood, 5 under. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After yesterday's 2% sell-off, the NASDAQ 100 right now, it is lower, down 22 points. That's a decline of about 0.1%. NVIDIA, Tesla, Meta, Amazon, they account for a lot of those losses right now. S&P 500, 6 of the 11 major industry groups, they are higher. Some of the defensive sectors leading the way there. You have utilities, healthcare, consumer staples. A biggest drag that's coming from communication services. And next week, a big one for investors as we look to the Fed meeting next week. Kareem Shadid at BlackRock says the inflation fight is not over yet.
It's still too early to call the victory in terms of making sure that inflation expectations are well and truly anchored. When we look at the CPI miss that we had, it's all well and great, and disinflation is powerful, but there are some components that point to potential re-acceleration later in the summer.
Right now, the S&P 500, 8 points higher. That's up 0.2%. 85.44 on the index. The Dow Jones Industrial Average is up 79 points. That's a rise of 0.2% at 35,302. And the NASDAQ 100 right now just turning green, call it up about a point. We check, nothing to write home about right now. Still waiting for that volatility to kick in. The average volatility right now, this time of day, it's actually lower, down about 0.1%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Simone and Maddie.
Thank you so much, John Tucker. Yeah, interesting to look at the NASDAQ having a very volatile week here. That volatility down a bit today, looking like the NASDAQ is unchanged, moving around a bit. Having said that, though, we are going to get a great guest to help us digest the trade of the day and what's been going on and what we can look to for the second half of the year here. We've got Brent Schutte with us on Zoom. He is the Chief Investment Strategist for Northwestern Mutual, and we're going to get to talk with him about the Fed moves and market movement as well. Brent, great to speak with you, and thanks for joining us on this Friday morning here. Talk to me about what the trade is based off of more these days. Is it based off of Fed moves or something like earnings results?
No, I actually think it's based upon inflation coming down. And so you've seen inflation decelerate rapidly over the prior few months. And that was the primary fear in the market that really peaked last October. I think you've seen that come down. We thought that would actually occur. That's the really good news. I think the bad news is there's still a recession on the horizon because I don't think the Fed is done tightening, even though current inflation is coming down. They're not done tightening until they see wage inflation come down substantially. The last 3 economic cycles ended with wage inflation running around 4 to 4.2%. That was the cap. That's not by accident. The Fed doesn't want a wage price spiral a la 1966 to 1982. And so they're fearful that if wages keep rising where they're at right now, that will pull that current inflation back up. And so unfortunately, I don't think we're going to get out of this kind of time period coming up without a recession, which I think will put a damper on stocks.
Yeah, Brent, do you see the pause, the one and done outlook for the Fed, or how much is that still variable in your mind?
I think it's all based upon one thing, the jobs market. Do more people come back to the labor market to provide competition to pull wages down from their current 4.7% year over year, which is non-supervisory and production workers? Do you get that pulled down into the 3% range, which I think is highly unlikely without them actually having caused some sort of labor market disruption, namely job losses, which we typically call as a recession. And so where is that point at? I think we've all been searching for it. It hasn't happened yet. And I think they'll keep the tightening bias on until they see that actually occur, which unfortunately is why I see a recession.
Yeah, I believe you told Surveillance just a couple days ago, our morning TV program and radio simulcast, that you see a short and shallow recession and that you became a bunch more bearish a few months